Okay, hey everyone, welcome back to Bald Prairie Real Estate. It's been a while since I have done a barbershop live stream like this. The reason I call it the barbershop is because, of course, that's where you're always sitting and chatting and talking about the world's problems. So that's why I call these live streams the barbershop. Like to make these as interactive as possible. So throw your comments in the comment section below that you have. We'll try to get all these questions answered for you. And I have what I think is an epic show for you guys because we are going double epic. The epic massive actually rate hike that we saw today from the Bank of Canada, 1% jump. That's the biggest jump since 1998. And I want to talk about Epic Alliance, the maybe real estate scam Ponzi scheme that was going on in Saskatoon. We're going to chat about that. And of course, these two awesome topics. No better person to bring on than my good friend Conrad Neufeldt. He's an award-winning mortgage broker from Saskatoon and knows this Epic Alliance story inside out. And of course, understands the rates and what's going on right now with the Bank of Canada. So I'm going to bring on Conrad here. Hey, Conrad, thanks very much for coming today. I'm glad to have you on. We got a pretty packed show today, so I'm excited to have you kind of break down our topics.
Yeah, well, thanks for having me. And I know because I'm a guest on your show, I have to do a bad joke because I know that's your thing. I watch your videos. I know that you got bad jokes. But hold on, I gotta pull it up here because it's a groaner. Okay. Why is money called dough? Because we need it.
Oh,
yeah.
Yeah. Okay.
See, I feel like that fits with your humor.
Yep. I love it. Okay. So let's start off. Topic number one, the big one, the epic Bank of Canada announcement, 1% rate hike. First time they've done 1% since 1998, I believe. That's the last time they've gone that big, that fast.
Yeah, so it's obviously going to have a big impact on a lot of things, right? I think a lot of people right now are like, oh my gosh, how do we afford our mortgage payments and stuff like that? And there is an element to that, but the impact that rate has goes far beyond just that singular worry of, can I make my mortgage payments, right? Like you're already seeing a lot of people talking about delaying retirement, right? So people who would otherwise be retiring are already looking at pushing that back because of mortgage payments, right? And it's affecting everywhere from really, really young people to really, really old people.
Yeah, it's definitely talk of the town. Even walking around in stores today, people were talking about. So everybody is, I think, keenly aware of interest rates, maybe more so than I ever remember people. It seems that everybody's talking about it right now.
Well, our parents, I think, would remember it a lot more.
Yeah, absolutely.
We're dealing with an entire generation that knows nothing other than flat or declining rates.
Yep. I mean, not double digits, like 15%, 18%, like it was.
Or 21, depending on when you bought. Yeah.
Yep. So, okay, 1%, that's a huge hike. That takes us to the Bank of Canada rate at 2.5%. When was the last time we were at 2.5% as a Bank of Canada rate?
Oh, that's a good question. I don't know off the top of my head. It's got to be early 2000s. I would venture to guess. Like I'd have to look it up to be 100% sure, but it's got to be 2 decades ago, give or take. Like we kind of look like a U-shaped graph is how we look. Like I don't know if you've ever seen the comedian that talks about like how there's like so much more out there. He's like, we live on a space rock. He's like, you think you're small, zoom out, right? Like, and then he's like, right. Well, rates are very similar to that right now. It's like, yeah, we've gone through some pretty significant rate growth. And then people are like, rates are so high. No, zoom out, right? Like if you zoom out, historically, we're still quite low,
really low.
Right? Like for the longest time before we had this 10-year period, where rates were suppressed for so long, the 100-year average was like 5%, right? Yep. And we're like half that, right? So it's, we got a long way to go before we get there. And there's a lot of factors that have changed over the last 100 years that make this a much different environment than ever before. But it's still notable to know that there's a lot higher that it could go.
Yeah, there's a lot of movement here. So let's quickly chat about fixed rates and variable rates right now. What is the best, or I shouldn't say best, but kind of what you're seeing for fixed rate 5-year mortgages right now, and then where the variables at right now, and probably where they're going to be tomorrow once the banks all make all their adjustments.
Yeah, so the banks have already started making their adjustments. Like we were seeing them come through as early as like 5 hours ago. So the prime rates are already being affected at a bank level, which is expected. Before I answer that question, I'm going to do some caveat, just because I know that when people watch these, they come from very different backgrounds, and there's can be knowledge gaps, right?
Okay.
So I just want to make sure that everybody has the same thing in mind when we're talking about those rates. So obviously you have fixed rates, right? And if you were to draw a line, that's the epitome of stability, right? Your payments don't change, your interest rate doesn't change, everything's, but you pay a premium for that. You get higher rates usually as a result of those, of that stability that you get. Those right now are at about 5.5%. Okay. There's still rates that are lower than that, pending good credit, good, whatever. Like there's still, you can get just above 5 in some cases. What we're seeing though is the fixed rates are a huge, or based on rather the bond market, right? They're largely based on that. So even while the Bank of Canada is making its adjustments now, what you actually have to realize is that most of those rate hikes have already been priced into the bond market. So it's not like, the Bank of Canada has raised its rates by 1%, fixed rates now skyrocket. The contrary is actually true. It's been relatively flat. We've seen some modest gains.
That it's been kind of flat for what, maybe 2 weeks, 3 weeks here?
It's been a really long time. No, like in this world, like in the last 6 months, it seems like every day we were getting freaking rate notices. But now it's like, it was like really quiet for 2 weeks. We're like, what the hell's going on? Like, so it's been quiet. We've seen some modest gains in the bond market now, but it's still lower than what it was before. So we're not expecting yet too many fixed rate increases. That being said, and this is, I'm sure, something that we'll talk about later on in the show, we are expecting that there will be more Bank of Canada adjustments in the near future. Yay. And if that's the case, what you're going to see is the bond market price those ones in. Yeah. So it's not that the bond market and the fixed rates are climbing to price in the old stuff, the 1% that we just hit. That's priced in already for the most part. Maybe not totally, but in a good chunk it is. But going forward, they're going to start pricing in all the new ones that are expected. And like I said, we'll probably cover that later. Then on the complete opposite side, so we talked about that spectrum. On the far right side, or I guess on the right side, depending on how this camera is oriented. The far right side, you got
to do this left and right. There you go. That'll tell you.
But I think it's different because you see this is right to you guys, right?
Whereas that's my right there. Yep.
So you got the fixed rates, which is great. And then you go all the way to the other side. And that's where most people think this is what variable rates are, where your payments change along with your interest rate. And for the most part, that I guess that's true. That's called an adjustable rate mortgage, an ARM. It's a type of variable rates because there's different types, right? So that one, if you go to the far right side, or the left side rather, where it's complete instability, right? Then as a result, you get some savings from that. Those ones right now are still going for prime minus 0.9, give or take. I mean, they're in that range. So the discount off of prime is still good. But of course, as of today, the prime rate has gone up. And that's actually a notable factor for something else that's changed, and that's pre-qualifications. And so we'll come to that in a bit too. But
now I just want to stop you real quick here. So Bank of Canada rate and prime rate, that's two different things. Can you explain the difference between Bank of Canada rate? Oh, camera kicked out there, but the Bank of Canada's overnight rate versus the prime rate.
Yeah. So the overnight rate is basically, so the Bank of Canada has their rate. Okay.
Yeah. And what is that rate for?
The overnight lending rate is basically what banks can lend money to each other at, right? Yeah. So a lot of times at the end of the day, banks have to, balance their books and have enough money for all the money that they've loaned out. And as a result, they have to be able to lend money to one another. And that's the rate that the government sets. It's like, if you're going to lend money to each other, this is the rate that you have to do it at, essentially. Okay. Which tends to be what the Bank of Canada is looking to do, is to try to drive up those costs. As a result, when the bank goes to lend you money, you can assume that they're trying to make a profit off of it.
Shocking.
So their prime
Banks
rate
want to make some money.
Right. So their prime is set above that, right? So the bank's prime is different than the Bank of Canada's prime rate, but they often almost always move in tandem. It's very rare that they're disjointed. They can move in tandem in the sense that they move both at the same time or quite close after that. It's like they're synchronous. And in the same pace. So it's very rare that the Bank of Canada will say, yeah, we're increasing it by 1%. And banks go, no, we're going to only raise half.
Yeah, we're going to eat that. Yeah,
you're right. Like, they're not going to. So in most cases, they do. In almost all cases, they raise the same pace and at the same timing as the Bank of Canada. So now you got this bank or this prime rate that's gone up. That's impacting your variable rate mortgage. But if you take one step closer to the fixed rate side of the equation, but still closer to that adjustable rate mortgage, you have something called a static variable.
This
Static
is the
variable,
fun one here. A lot of
yeah,
people don't know
that's
about
where
this
your
one.
payment stays the same, but
Yep.
your interest rate changes, right? And so what's actually changing is every time you make a mortgage payment, it's comprised of two parts. And this is true regardless of which mortgage you're on. Principal, actually paying off the loan, and then interest, that nice expensive thank you we give to the bank every month. So the variable rate is, or that static variable, all that's changing when that interest rate changes is how much of your payment is going towards principal versus interest. As rates go up, more of your payment goes towards interest. And as rates go down, more of your payment goes towards principal. But it does
So
provide some stability in terms of the rate fluctuations that we're seeing.
now, in my understanding, there's a trigger point in these
There
static
is.
variables where if at some point interest rates have gone up a certain amount, and
Mhm.
obviously now that is probably going to now affect your amortization left. So the bank is going to go, okay, yeah, it's static to a certain point. So quickly, kind of what's that trigger point when all of a sudden those static
So
variables
that's actually a
become
really good question.
adjustable variables?
Yeah, it's static to the point where the payment always has to cover at minimum the interest.
Okay.
So if the portion of your so as
So
interest
let's say
rates
a
climb,
$100 mortgage payment and it's $50 is interest and $50 is
$50 is
principal.
principal, yeah,
Yeah.
and then all of a sudden interest rates change such that you'd need $110 of your $100 payment to go towards interest. That it now triggers it so that your payment now starts to go up. So at the minimum, you are covering the interest. So your
Okay.
payment would be $110. So once you've actually hit that trigger point, every consecutive rate that goes up beyond that, you're going to feel because
The
you're
same
already
amount as
past that
an
trigger point.
adjustable rate variable then at that point,
Pretty
basically?
much, yeah,
Okay.
pretty much. So I mean, not to the full extent, but you're going to feel it in some proportional capacity. Because once
Okay.
again, in the adjustable rate mortgage side of things, as the payments change, it's also accounting for you paying down principal faster,
Yep.
which you don't have that portion of it. So
Yep.
it's not the same as the adjustable rate mortgage. I should clarify, it's not the same, but you will feel it because every portion, every interest portion that you have is now getting tacked onto that payment every single time that they change. And what's
Yep.
interesting about that is to date that hasn't happened yet. We have nobody that I'm aware of that has a static variable that has hit that trigger point
Okay.
yet.
Yet.
We're damn close, and we're going to start seeing that. And so there's a lot of people out there who locked in probably the worst case scenario probably would have been the end of 2020, 2020, end of 2020. Those people probably had the biggest discount off of prime and
Yep.
probably had the lowest rates locked in at that time. They're probably going to see that first.
Yep.
And that's going to start having a pretty interesting impact on the market because now everybody, not everybody, but almost everybody with a variable mortgage, both ARM and static, are going to start feeling the pinch every time rates change. And
Yep.
that's already starting to have a pretty significant impact.
So before we start talking about the pinch here, quickly, anybody who's just been joining us here, we've got Conrad Neufeldt. He's a mortgage broker out of Saskatoon. If you guys have comments, put us in the comments below. That's why I'm looking over here. I check in the comment section so we can flash them up on the screen and get those questions answered. So anything kind of mortgage related, how much these rates have gone up, anything like that, Conrad's happy to answer that for you. But let's talk about the pain. So every quarter point bump, of course, now we've essentially done 4 quarter point bumps with it being a full interest point bump
Yeah.
today. That's a big one. And we'll get into some more fun topics on that later. By the way, as well, anybody joining us, we're going to be talking about bank rates right now. And then the fun topic, I think, at the end is going to be Epic Alliance, which was a real estate investment company out of Saskatoon that controlled hundreds of properties, something like 600 or 700 of them. They went bankrupt last year, and there's a bunch of stuff that happened there that's really interesting to talk about. So we'll get into that later on today. But when the interest rates go up, every quarter point bump, roughly $13 per 100,000 borrowed, correct?
Yep. Yep.
So average house price in Canada is around $750,000 to $800,000. What's the average mortgage right now? Do you know that off by hand?
Yeah, so it depends on which market. I don't know every market.
Yes.
Like Saskatchewan, for instance, like Saskatoon's like 285.
Yeah. That's
Regina,
the
I
average
think,
mortgage. Yeah.
is average mortgage. Yeah, that's correct. Average, and that's removing the noise. So that's removing all of like the people who own a home but don't have a mortgage.
Yeah. So actually, we'll back that up even more. For those that don't know, if you kind of break out property in Canada, a third of households are renters, a
Yeah, that's right.
third are households that have a mortgage, and a third are households that have a house, but they don't have a mortgage. So when we're talking about these rates going up, it's only going to impact the third of owners that have a mortgage or homeowners that have got a home equity line of credit. But let's just stick on the homeowners that have a mortgage right now. What percentage of homeowners that have a mortgage currently are on, or I should say historically, have gone with fixed versus variable? Because that has changed quite a bit
Mm.
from my understanding.
It is, yeah. So the fixed versus variable story is kind of interesting because ironically, so last year I was a massive proponent of fixed. I was
Yep.
like 98% of my clients were fixed, which should tell you something because even in that market where I was like pretty pro fixed, there were still times and places where variable made sense for some people. There's not a one size fits all. I'm always very clear on that.
Yep.
But then, like I said, 98% of my clients fixed because that was like a no brainer from what we were seeing from a strictly rate potential for rate going up.
So I'll
Um,
pause you real quick here, though, just
yeah,
on that, because hindsight is really 2020 on this
yeah,
question. And I was one when I took my mortgage, I went with variable because I bought into the Bank of Canada saying that they were going to keep rates low for the next 2 to 3 years.
yeah,
And that when, at least my thoughts at the time, and I know my predictions video that I did, I wrote it in December and shot it and put it out in January of talking only 2 or 3 rate hikes. Well, that got blown out of the water really fast. But I was expecting rate hikes to come on slowly. I wasn't expecting them to kind of open the doors. So, restrictions would just fall off and all of a sudden, boom, the economy's basically
yeah.
full bore. And then the rates went through the roof. So I think there's more than a few people that got caught expecting rates to stay low for quite a while. And that didn't happen. The Bank of Canada, I'd like to say they did a 180, but I don't think it's a 180. I think they slammed right into the concrete wall.
Yeah, and like I mean, I've got videos on this topic from as early as early 2021 when the Bank of Canada, everybody's saying interest rates won't move until a minimum 2023, maybe 2024. And
Guilty.
I was like, yeah, well, I was one of the only people that I know of that was saying that's just like it's possible, just highly improbable,
Yeah.
right? Like I was like, it's most likely they're going to do 2022, right? And like we live in arguably one of the most interesting times from a financial perspective. There's literally more factors going on right now than literally ever before in
Yeah.
Canadian history.
It's the most complex real
Yeah.
estate and mortgage market I think we've ever seen.
Well, just in general, because you have what you typically have is a ton of people who've taken it upon themselves to invest their own money, to do
Yep.
their own financial decisions more than literally ever before. You see the rise of wealth simple, you see the rise of Bitcoin and people making their own asset-based investments. You see all those changes, right? Why that matters is when you have the Bank of Canada. The Bank of Canada's mandate is essentially for stability,
Yep.
right? And so you got people and other YouTubers who are saying, "Oh, interest rates are always flat and stuff like that." Well, yeah, maybe, but interest rates are flat because of a very, very different reason, right? And what is that?
I put a comment. Finish your sentence, and we'll get onto this
Okay.
the comment here.
So the interest rates were flat, but only because prior to 1971 they didn't have a choice, right? It was fixated to gold, and there's a whole I've got a video all on that you could watch that have that. But people were always talking about, oh, they have to raise it by a quarter point. Why? I mean, historically, that's actually rarely the case. We're only used to these quarter points because of the last 10 years. If you look at it historically, the changes are much, much larger and much more wide sweeping and more frequent too, right? So, we're talking about like back in 2021, I was like, the odds are that interest rates are going to go up. And when they go up, this, and this is going to happen. And so,
Yep.
like I said, there was a few of us that were predicting this. But the great part of it was it didn't matter if we were right or wrong, because at the time, the fixed rates were only going for like 20 basis points, 35 basis points.
It wasn't much of a
variable.
gap for a while.
Like,
For most of the time, it's like a percent or two.
yeah,
But there was a time, where the gap was
it was super,
basically
super
nothing.
small. So it's
Yeah.
like, and I always like, my favorite question is, what if I'm wrong? Right? Like,
Yeah.
plan for that scenario. If you're strategic plan requires you to predict the future in order for it to be a good plan, that's a freaking shitty plan,
Yeah.
right? Like that's a
great.
terrible plan. So like I was like, look, you're good either way. If rates rise, you are solid. Like we were locking in, I locked in one of the lowest rates in Saskatchewan, a 5-year fixed at 139. I mean, that guy is freaking thrilled. I've got 10-year fixes out there for like 219, right? Yep. And those guys are right for the next 4 to 9 years, so that they're more than covered. And obviously they're writing me saying thanks so much, right? But like the reality is that, you know, if you're wrong and rates don't change and they just stay the same, so what? You missed out on $30 a month?
Yeah, not a big deal.
That's nothing. And take the gamble that I'm going to be right, and then if you're wrong, frick, I'll write you a check for $200. You know what I mean?
There you go. You heard it here. Conrad is writing checks to everybody for.
That's right. No, I'm not. No. This market's very different. This is a 50-50.
So let's get into some of the questions. First one here, Clean as Dirt, regular viewer of mine, awesome commenter, talking about the stress test. So we'll quickly talk about that, and then we've got a couple of comments or questions I think we should get into here, and then we'll work our way back to our discussion we had originally. But first one, stress test. I know a lot of buyers and realtors were a little frustrated when the stress test came in because it knocked out a pile of,
I think it's 2016.
A pile of buyers' buying power. It took about 20% of your buying power away. And for us here, for example, in Saskatchewan, where our market was fairly soft, and that really hurt us because all of a sudden it completely changed what buyers could afford overnight, basically. Yeah. So for those that don't know, the stress test, if you're buying a house, you have to qualify at 2 interest points higher than your quoted rate. So if you're quoted 1.5, you have to qualify in 3.5, or the stress tested rate, which currently is 5.25%, whichever is higher. So that means right now that anybody who's bought in the last couple of years has been stress testing on roughly 5%. It's fluctuated a little bit, but roughly 5%.
Unless you're variable.
Unless you're variable. Well, no, because the stress test rate would have been 5.25%.
That's right. That's what you're saying. Yes. I see what you're saying.
So they would have qualified on 5.25%, meaning that in theory, these homeowners on variables were able to withstand a significantly higher interest rate. I mean, everybody was basically laughing, going, I'm qualifying on 1.5, but I'm going to have to qualify, or I'm paying 1.5, but I'm going to qualify on 5.25. This is ridiculous. Rates are never. But
see, I think the people though that were arguing most against it, at least the smart ones that I know, like there was obviously some people who were complaining about it, like, oh, why are we qualifying? But I don't think, like, I, for instance, was complaining about the stress test, but not because the stress test existed. I was complaining about the application of the stress test. I think there was a better way to implement it than the way that they did it. For instance, okay, why, if I'm getting a 5-year fixed, why on earth am I qualifying at higher? That actually doesn't make sense. Like, or more so let's leave the 5-year fix alone, because we could argue that actually makes sense. Let's go 10-year. Let's say I lock someone at a 10-year. Why do you need a stress test at all? Right?
They're not going to see impact rates for 10 years.
For 10 freaking years. It makes no sense. So the application, but on a variable, absolutely it makes sense, because you're at the whim of the market. And as we're obviously clearly can tell, it can change. So like for certain buyers, it made sense. I'm just saying for certain buyers, it didn't. So I was saying more the fact that it was like a universal application. That's more the thing that I didn't like about it way back when.
And it's tough. The stress test is, I mean, a typical any government policy, it's going to be wide reaching, and it's tough to kind of make it as nuanced as maybe it needs to be. It's tough. I want to jump real quick here, a couple of comments, just so we can keep track and get. There's a lot of people with really good questions. So I want to get you guys all in. I'm going to throw a few on here because this is going to trigger some comments. Wish they didn't have the stress test so they could have all burned. Market could have crashed. With the next one here, Steve. So, Steve, I understand the sentiment of going, I want the prices to decline because I want to get into the market, or you're pissed off because investors are buying properties. I understand that sentiment. Both Conrad and I work in markets where we went through a very significant correction. And that's why I think both of us kind of have a bit different perspective on what that looks like. Here in Regina, we saw prices citywide decline over 25%. There was neighborhoods that saw 70% declines. That was substantial. Even I remember one of my first years in the business, so that would have been 2012 roughly, and there was selling a condo. It was $175,000 was the price we get on. And the seller was mad at me, just mad, going, I can't believe I'm giving this thing away. Today, that same condo after market has appreciated a little bit, sells for $100,000.
Yeah.
So that price, I mean, if he would have sold all of them, he looked really, really good in comparison to where he is today, where he's still got about a dozen of those units where they've dropped substantially. So not only is it, tough on everybody, because to have the economic conditions to create that significant of a crash, everybody feels a lot of pain. We saw it here, significant job losses, how much economic pain, how many businesses went out. That's a really tough situation to be in.
Well,
So
and I will always
go to the next one.
Oh, so I was just going to say, I would also put a caveat on that. Be careful what you wish, what you wish for, rather, because like there's only so many houses out there to buy, right?
Yep.
And unfortunately, what you find is, people who are hoping for the market to crash, they want to buy. In their minds, it's, if it was just cheaper, I'd be able to buy. But the reality is if it's become cheaper, if let's say there's 100 buyers and there's 50 houses, and you're buyer number 51, right? Whether the housing prices are this or this or this, you're still buyer 51 and you still don't get a house, regardless of what the price is, right? Because the price is being determined by how many people can buy that. And if you're in that lower bracket, there's nothing that can launch you forward. So what's worse than that is all that ends up likely doing, at least historically and statistically, is driving up the rent that you're currently paying and nothing more.
Well, and it's something we're seeing. We'll get a little sidetracked here. I want to get to this question here real quick. We're seeing, especially in Toronto or Ontario, where buyers are really uncertain right now of what's going on, and they're taking a step back from the market. And that is, and something I'm going to talk about market update, part of why we're seeing a really big slowdown in sales. We're also seeing a massive slowdown in new listings. Inventory isn't changing very much because sellers are a little nervous right now. And so a lot of very qualified buyers have said, you know what? I'm going to hold off here. I'm going to take 6 months or a year out of this and just see what happens. As soon as they start seeing that, hey, things have stabilized, we're not seeing more rate hikes, market's normalized, they're going to jump into the market. But what is happening in the meantime is now they're competing with people who are ready to buy, yet they're renters. So you've got qualified buyers who want to buy a house who are now competing against renters to get a rental property, and there's a massive surge in the number of houses being rented right now and the prices. And so that's kind of the negative of we're seeing this market right now is rents are going through the roof, and of course landlords are not going to eat 1%, 2%, 3% interest rate changes. They're going to increase rents as well if the market will bear it. So Conrad, this is a good question for you here, is how will this affect people who are hoping to get pre-approved to buy a house, this rate hike?
Good question. That's a really good question. So a lot of people on here are probably too young or don't remember or weren't in the industry. That like prior to, I think it was October of 2016 or June of 2016, rates used to float a lot, right? And so too would your pre-qualification. If rates went up or rates went down, your pre-approval or pre-qualification could change.
Daily sometimes.
Same thing now. And that's why this 1% change is actually more important than most people realize. Prior to this, in the last, let's call it 8 months, any of the changes that were happening, either with the fixed rates or the Bank of Canada or whatever, all of them still allowed you to retain your original pre-qualification outside of a 120-day window. That's a caveat. We're going to come to that in a second. Outside of that, because you could always use the 5.25% qualifying rate as your qualification rate.
The worst case
just
scenario.
Have to go variable, right? That's changed. Now with where variable rates are, and you add that 200 basis points, 5.25 is not the lowest or not the highest point on any rate that you pick now. That qualification line is pretty much useless. So as rates are changing now, so too are your payments, which means that if you're intending to go variable, there's a really good chance that your pre-approval amount is going to change as the rates change. There are ways to insulate against it with rate locks and everything else, but that requires you to be within that 120-day rate window most often. Some are 90, but most are 100.
And for those that don't know, when Conrad says basis points, it's kind of a mortgage term that's used.
Oh, yeah. My bad.
So 10 basis points is 0.10%. So you hear 250 basis points. That is, or sorry, 100 basis points here. In this case here, that's a 1% increase. So 25 basis points, quarter point. That's kind of some language there for you. So yes, for those that are looking to get pre-qualified, these rates now, if you're looking at variable, you got to qualify in 2% higher than your quoted rate, which right now we're seeing what 3.6, but that is going to go up, or we're going to go up to 3.6. Are we not here? For most
so
variables?
I would be asking your bank, your broker, whoever the heck you're using. I would be asking them, like, first of all, do I have a pre-qualification or a pre-approval? Because pre-qualifications are going to change. Pre-approvals are locked in for that period of time. So that's going to be important. And then is my pre-approval based on fixed rates, or is it based on variable rates? We used to have the conversation, like, after you've put in an offer, let's talk about the different rate options and stuff that exist. We're having that conversation a lot earlier now, because if there's rate locks that we have to submit for, if there's a good timing for that particular client to submit a rate lock, we need to know, what are you doing? Right. And we talk about the pros and the cons, and of course everybody's different, but as the market changes, so too does the recommendation. But you got to have those conversations early. You have to know what you're walking into before you've even found the house.
So here's a good question here. Steve has, sounds like people will looking to buy will now qualify for much less than before because of the rate hikes. And I think this is one of those it depends questions, is it not? So let's quickly run through that. Let's say somebody was looking to buy a house, from a lot of markets. Ours actually is not one of those, but say Vancouver and Toronto, where kind of prices seem to have peaked out in about February to March time frame. They were looking to buy then, and they were qualified to buy then. How does that impact them today?
As a whole, the statement itself isn't necessarily wrong. People will qualify for less than before the rate hike, potentially even much less, depending on a variety of factors. So the statement as a whole is correct. The impact on the market might not be as dollar for dollar as you might think, though, because what you'll find is most people aren't buying at the tippity top of what they were pre-qualified for. So someone might be pre-approved for 980, but buy a 650. That same person might now be qualified for 750, but still buy 650.
They're still going to buy 650,
right? Yep. So they're tapping out a bit more. That's yep. True. They qualify for less, but it might not necessarily impact their purchase yet.
It's one thing I always tell my buyers: go to the bank, ask them, how much money will you give me? Because I've had buyers say, I want to buy a house for 250. And I know when you're from Toronto, that number sounds hysterical. We can buy some pretty good houses in Regina for $250,000, but they say, I only want to spend 250. There's a bank goes, yeah, no problem. Qualify you on 250. Not realizing that they could have potentially qualified for more. And again, our market, $25,000 or $30,000 makes a massive difference on what kind of a house you get. You can get quite a bit for that little, small amount of money. So I say to them, go ask them what's the most you can borrow. Then go back and do your budget and say, what actually works for me? And price in increases in cost of living, whether family changes, if you're having kids, things like that, interest rate hikes, like price all that in as best as you can. Nobody has a crystal ball. Nobody can be perfect. Price that in, do your budgeting and go, okay, I was qualified at 980, but no, I only want to spend $450,000 because that's what I feel comfortable with. So that's where, yes.
And I usually tell them 3 numbers. I say, here's the maximum you can pre-qualify based on how everything's going on right now. You can qualify for a little bit more if we change some stuff. It relies on some exceptions into the file, which may impact your interest rate. So that's something to consider if you go above that number. But if I were you, I would be buying at this number. And it's often much lower than those 2 numbers.
Yeah. So another question here. This one's talking about static variables. We talked about this a little bit, but I think we can explain it more. So static variable mortgages, mortgage being about the trigger point, kind of what are their options? Can my amortization be increased to 35 years, currently 30 on a static variable?
So if I'm understanding this question correctly, they have a static variable.
Correct. Yep.
And they're reaching their trigger point. That one is tricky. It's tricky for 2 reasons. One, the lender that you're at doesn't necessarily support 35-year amortizations. You rewind 8, 9, 10 years ago, 40-year amortizations were easy. They were the norm. Then it shrunk to as low as 25 years if you're getting high ratio, which is mean you're putting less than 20% down. But if you're above 20%, which in this case you would be, you could go up to 30 years. That's where most traditional lenders cap themselves off, is 30. Very, very rarely do lenders allow you to go to 35. The problem, though, is that, and so as a result, those lenders, when you want to go 35, you end up getting an even higher rate than you would otherwise get. So what you'd be looking to do is something called a switch transfer. But unfortunately, what that would mean is that they would have to now qualify you for that mortgage based on all the new rates. And given the fact that even though you're extending the amortization from 30 to 35, my guess is, depending on how leveraged you were, the change isn't going to save your payment all that much. In fact, you're probably even more likely going to end up with an even higher payment than the one you had now, depending on the timing of when you locked in that previous mortgage. If it was prior to February of this year, the odds are very, very significant that you're going to end up with a much higher payment than the one you have now, despite the fact that you're amortizing it over a longer time frame.
Okay, so I hope that answers. And by the way, everybody here, first of all, thank you for the awesome questions. We love getting through these here.
These are good.
We have a whole script written up, and I'd be just fine to never even touch this script except when we get to Epic Alliance, because I want to answer your questions. That's why we do these live streams. We don't want to just talk to each other. We want to talk to you guys. And if we have gone through your question and we didn't answer, or you have a follow-up question, again, throw it in the comments. We'll make sure to circle back to it here. So I'm going to scroll down here and get to, there's a couple of good ones here. Let's quickly chat. Okay, here's one. Here's a fun one. Prediction time. I mean, all of us got our predictions blown out of the water. How high do you think rates will go?
So I'll tell you what I'm going to stay true to one part of my prediction, like last year I was predicting rates were going to go high, or rates were going to change. They were going to go higher and fast. I had a different idea in mind as to what fast meant.
Yep.
So that's the part I'm wrong on. I'm not wrong on necessarily the end destination. I'm definitely wrong on how fast we're getting there. Because even like last year, I was saying, hold on, because in 5 years, it would not be impossible to see rates of 6 to 8% for fixed rates. It would not be impossible to see an 8% 5-year fixed rate. This is what I was saying last year when everybody was saying Bank of Canada isn't going to change their rates until 2023. I look like I'm freaking this Chicken Little. Yeah. So I wasn't wrong in the direction, or even necessarily, I was wrong on the speed. We're getting there a lot faster.
Yep.
The market can only take so many rate bumps, and not in the sense that most people think it is. A lot of people think, well, the market can only take so many rate bumps because then I can't afford my house. There was a song, "You're Not That Special," even though you think so, right? Well, unfortunately, whether you can afford your house or not has almost zero bearance on what the Bank of Canada is doing. For instance, if you notice today's rate hike, we moved it up 1%, and already you're seeing a strain on the Canadian dollar. Hasn't jumped up a ton, but the Canadian dollar is starting to feel some upward pressure. For those that want a quick lesson in economics, as far as trade is concerned, our sweet spot for currency is 77 to 78 cents. That's our sweet spot compared to
against
the American
US dollar.
That's right. Anything higher than that, and we start to see our exports go down, which is a recessionary pressure. So the Bank of Canada is between a rock and a hard place. Cause a recession by increasing the rates too high relative to the American rates, or causing a recession.
Increase, yeah.
That's right. So if you create that recession, right? But here's the thing, and this is why it's really important to pay attention to what's going on in the States. We saw a 75 basis point increase back in, what was it, May?
And that took them to
2.5. Yeah. And so we looked at that and we said, well, if they went 75 basis points, if you've ever heard me, what I said before is it's going to be 75 basis points or larger come July 13th. And there's a reason why I said the or larger, because I'm like, it's actually possible, because we're hovering around 70 cents, 77 cents already. It's quite possible we're going to take the opportunity to strike and go a little bit higher.
Yeah.
Here's why that's relevant. Here's why that's important. Feds are meeting again. The states are meeting again at the end of July. And there's a really good chance they're going to do 1%. And if they do 1%, hold on to your seats, because there's a good chance that comes September 7th. Yeah, there's a good chance come September 7th, we're going to see interest rates of 75 basis points, so 0.75 to 1.25, right? So all of a sudden, you're going to have the situation where, we could see a rate equal or greater than the one that we just saw. So is it too much? I mean, maybe, but at the same time, it's a rock and a hard place, right? You go too little and the currency becomes weak. You don't want that either. So the rates I still think that come 5 years from now, interest rates for 5-year fixed will be in that 6 to 8% range. And we're almost already at 6. So I still think I think it's going to calm down a lot. I do think the next 2 years are going to be interesting. 2013 is going to be an insane year. 2023. What did I say? 2013?
Yeah, we're going back to the future. Great movie.
That's right. 2023, I think, is going to be an interesting thing. I think we're going to see some rate hikes, but depending on a enormous amount of factors, and anybody who tells you that they have this narrowed down for sure is a moron, because there's just so many factors that play into this. But I think come 2014, I think that's where you'll see a moderation.
2024.
What the heck? 2024. Yeah. I'm living 10 years in the past.
Back to the Future. Don't they go to 2021? I think that's what it was, or something like
Yeah,
that. We'll have to
I
look
bet
into
you
it.
their 2021 was a
Somebody
lot
put it in the
better.
comments below. I think they go to 2021 as the future,
their,
by the
their
way.
2021 was a lot better than ours, I think. But anyways,
Okay.
2023 moderation, 2024, I think we'll start seeing a moderation of rates.
Okay, so basically, nobody has any idea how high rates are going to go and when they're going to stop. I think I've said it for quite a bit. They're going to go till they break something, and we don't know when
Oh,
they're going to break
for sure.
something, and then
Yeah.
they're going to back it off. I don't think they'll flatten it. They're going to overshoot this, break something, and then go, "Oops, we screwed up," and then you're going to see a drop in it. And who knows what the heck they do then? So,
And by the way,
great
someone
question.
commented, Just Day commented saying they go back to 2015 and
2015. Okay.
Yeah. So we have our answer.
Yeah.
Thank you, Jess.
Okay, next question. Will there be an increase for condos, townhouses? And I think we're already seeing that.
Yeah.
We saw the pandemic put a paradigm shift in the way buyers think and immediately went to I need to get out of the city, away from people. I need a home office. I need to get more space for my kids, that type of thing. And so single family homes went wild in the suburbs, especially.
Mhm.
And then as the pandemic has cooled off, I think two things have happened. One, we've seen people go, "Hey, I kind of like being downtown again. I like being close to all those services, amenities, sports, that type of thing." And prices of single family homes have gone up so much. The gap between single family homes and houses, or single family homes and condos, has it's great gone up so much. I think in Toronto, for example, 2 years ago, the gap was like three or $400,000 between single family home on average and a condo. And at one point this year, it was almost $1 million gap.
Yeah.
So all of a sudden now, and with people being able to qualify for less and prices have gone up, I think the demand for condos, townhouses, etc., is going to be higher.
And I think you could also look and take a lesson from other countries that have had this. I mean, we're a small population. 38
Yep.
million people is not a big population, particularly for how spread out we are for the most part. I mean, obviously there's big central concentrations in Toronto, Vancouver, Montreal, etc. But for the most part, we're pretty spread out. And if you look at the growth over the last 100 years in some of those places, you're seeing that condos and townhouses are being seen as a way of getting more people into more areas. Because it's not just about houses; it's about how can we fit more people in a smaller area, so that we don't have to pave as many roads, have as
Yep.
much sewage and water and electricity and blah blah blah. Like the infrastructure there alone is difficult to manage.
Yep.
So there's multiple reasons why they're looking at doing that. Like even in the States, if you look at what they've been doing recently, there's a big trend right now for something called workforce units, right? Which are these small 16-foot like wide units that stretch a little bit longer, but they're like basically 1-bedroom apartments, and they're built quite literally to be affordable. And that's it, right? To help people get it, like escape the cycle of rent and give them a place to live. It's not going to make you $1 million, but I think if you start seeing the advent of that come along, the more spacious condos or townhouses are going to start seeing an appreciation even more than that, because it'll be seen as a step up from that.
Okay, so more of a comment here. Buyers have disappeared. The Canadian real estate market is like an overloaded paper bag with a wet bottom. Buyers have disappeared. I will just say that I think that statement is very much regionalized. Buyers have disappeared.
Agreed.
I don't know about you, Conrad, but we're pretty busy here in the prairie still. In fact, Regina still is an extremely active market. Saskatoon, very similar. Calgary, like all these areas, there's still a lot of buyers transacting right now. And even in Toronto and Vancouver, when I'm talking to my friends out there that are agents, they're saying we've got a ton of buyers that are ready to pull the trigger once they feel confident that there's
Agreed.
stability. Everybody is really, really nervous right now. And this is something I'm going to talk about, I think, in future videos. Right now may be an exceptional opportunity in this window we've got here of instability to buy a house at a lower price, because once we see stability, those buyers are going to come back to the market. And unless the government decides they're going to completely do a 180 on their immigration targets and shut down
Which they will
immigration,
not.
I don't think they will. We're going to have those new Canadians coming in, competing for the rental market and potentially purchases. And all these buyers have been sitting on the market, sidelines waiting. They're going to come back here again when that stability ends. And nobody has any idea when this instability is going to end. But I would say the buyers have not disappeared. There's still areas of the country that are extremely busy, and even the areas where it's quite a bit softer. That's because they're nervous. They're waiting things out.
And I agree with the comment to some extent. Like in the sense that it seems like buyers have disappeared, especially if all you're doing is reading the news. But or if you're in one of those markets that has been significantly affected, but I would agree it's highly, highly regionalized. Like even last month, we had more, we processed more mortgage volume last month than in any other month in the history of my entire career.
And for those that don't know, Conrad does mortgages not just in Saskatoon, but across the country. So this is not just Saskatoon or Saskatchewan seeing a ton of volume. This is across the country here.
Yeah.
There's people out looking to buy. And again, those are just joined us. We're going to be talking about rates here for a little bit. The second topic we're going to talk about here, I'm going to try to get into it here in about 15 or 20 minutes, is going to be the Epic Alliance collapse. And then that's the nice way to put it. For those that don't know, Epic Alliance is or was an investment kind of plan in Saskatoon where they had hundreds of properties. It was really slick, guaranteed, keyword there, guaranteed return on your money if you just give them X amount. It didn't go that well. Sign me up. Okay. So let's get on this one here. How do rates and qualifications change based on primary, rental, second, or even STR?
So primary, we talked about that one kind of already. Yep. So we know that those are changing. Rentals and second homes. Those are at a premium. Rentals more than second homes, obviously, because there's less risk factors there. But rentals have always been sold, or as far as rates are concerned, at a premium. The rates changed relatively dramatically in the past like year as far as like rental rates were concerned, and then really slowed down. Like they like really jumped up, and then it was like primary slowly start to catch up, right? Yeah. Like there's still rentals that you can get for like 5, 6, 4, maybe even a little bit less depending on how you've structured it, right? So it's not over like for a 5-year fixed. So that's not overly crazy historically. Like the gap is quite narrow right now. So I suspect that rentals you're going to start seeing more of those increases, which I'm sure for the really leveraged investors is going to be a nasty surprise. Yep. Short-term rentals, the STRs, those are your Airbnbs, that kind of stuff. Good luck. Those ones, they hate, like lenders hated them to begin with. Like most lenders hate STRs, short-term rentals. They just hate them. And now with the rates going up so much, and with Airbnb in particular, like there is, I can't remember what the stat was, so I apologize for that off the top of my head, but the amount of short-term rentals, Airbnbs that are currently struggling or underwater is substantial.
Yeah,
because you've got less people renting them, or I guess a little bit more, but the costs of them, often with those short-term rentals, a lot of them weren't fixed payments. A lot of them were some kind of floating payment that went along with the market, and I think a lot of them are struggling. So, you know, if you were like, not that this is like condones advice or anything like that, because I have no idea your situation, but if I were you, I'd be staying away from STRs like for quite some time, unless you have like a really sweet vacation spot.
Yeah, and there's lots of areas where they can be extremely, extremely profitable.
Lucrative, for sure. Absolutely. But you gotta be careful because financing sucks for them.
Okay. Will increased rates slow down building, construction and material costs and things like that? So I'm guessing here we're talking, will interest rates, the rise of interest rates, increase the cost of building and slow down building? And I think the answer we're both going to say is yes.
Yeah, to a point. I'm yes and no. So the rates slow down construction, right? And so to some extent, once again, depending on where you are. So there's less demand for those products, but there's still quite a bit of supply issues that we're seing right now. Yep. The war in Russia has had a bigger impact than I think Ukraine. A lot of people Ukraine. War from Russia to Ukraine is having a bigger impact. And I mean, honestly, as both Canada and the United States, we did a phenomenal job at shooting ourselves in the foot with regards to oil. Like we're so dependent now on foreign oil. And guess what? They don't care if you can afford your home, right? So they jack up the price.
We had this place where we could, drill oil and we could refine it here in Canada and provide great jobs for everybody.
Yeah,
and
but we don't
provide lower energy costs. That'd be fantastic, wouldn't it?
Oh, we did. Like I said, we're so dependent on foreign oil. Literally, the cost of everything is going up, whether rates go up or not. Yeah. So, you look at cardboard. Cardboard went from 60 cents a box to $1.20. Like,
MDF, lumber, drywall,
literally everything, right? So roof. It's not even the reason why I say cardboard is because that's not even related to housing at all, right? Yeah. So you're going to see the rising prices regardless. You might see it rise less because of reduced demand, but you're still going to see rising prices. So you're right. Slow down would probably be the term, but not stop or reverse.
Okay. this one here, talking about corrections, and these are numbers that I see a lot.
Hmm.
People saying, I want a 15, 20, 30, in this case here, I hope a 50% correction. That's what they're expecting. I guess this depends in terms of what your scale is. If you're talking one neighborhood, that's entirely realistic. If you're talking citywide, that is a lot less likely. And if you're talking nationally, a 50%
You don't
correction,
want that.
well, you don't want that, is first of
No,
all.
you're unemployed.
Yeah, we were in an extremely significant economic recession. We're blowing the water out of the Great Depression type of thing.
Yeah.
Um, at that type of number. So yeah, I understand the sentiment saying I want to buy a house cheaper. Trust me, I understand that. I mean, a lot of people maybe don't realize this, but I've heard a lot of times say, well, realtors, you want prices to always go up so you make more money. You know what I'd rather have? 2 people, 3 people, 4 people buy houses because they can all afford to buy them. And then they send me all their friends. If you want to talk to purely selfish, I'd rather sell a whole bunch of people houses and all they can afford to buy houses because I make way more money.
It's true. But I also think too, you got to be careful with the numbers that the media repeats too, because
Yes.
sometimes they're all talking about different things, right? Like we
Yes.
saw one, it's like, oh, sales are down 45% in Toronto. Okay, so what?
Except, yeah.
So sales are down. Sales are down from
Well,
the largest housing boom in the history of the entire country. Well, no
I was
shit.
just talking to a guy from Toronto this morning in prep for this show. Sales down 40%. That number sounds really scary in comparison to 2021 last year, where they were up 30%. So we're down 10 basically from a normal year.
Exactly. Like
It's
it's
not,
all what you're basing it on. So like
yeah,
year over year. Okay, well, don't compare year over year. Last year was an absolutely insane outlier of a year.
yeah,
No statistician
nothing
in
makes
the
sense.
world would compare the out like what's going on now to the outlier. They just
And that's
wouldn't. So it
why
makes a fun
I do it
stat, but it means nothing.
in my market updates, guys. That's why I always put in versus the 5-year average. I even stopped really talking year over year just because it was not making any sense anymore. The numbers were stupid. So I just have gone to a more simplified, here's what it compares to the 5-year average, which is, I think,
That
a more
yep,
realistic
5-year moving.
view of what's been going on. It's a 5-year moving average. So
Yeah.
even my numbers that I report in my market update actually includes last year's stupidity, but at least gives you a snapshot in
Yeah,
comparison to
but
what's
it's
happened in
washed
recent
out in
history.
the average, which is good.
Yeah.
Yeah.
So, here's a good one. Would you suggest variable or fixed rate now? And this is I think a question of it depends.
It definitely depends now more than ever. Entirely on so many factors. My recommendation for most people, most of the clients that I've had in the past was in the past, let's say a couple months, has been static variable. Not a variable, not adjustable rate mortgage. We talked about that earlier in the show, but static variable. I think it addresses the question, what if I'm wrong, really, really well. And I think prepares a lot of people for rate hikes if there's continues to be some, at the same time as keeping those payments stable. So typically the advice is static variable with your payments set to whatever your payment would have been had you gone fixed.
Okay. Another one
That's very broad though.
very broad.
Careful
Another
with that.
one here that I've often said is if rate hikes are going to keep you up at night, just go with the fixed.
Fixed,
Like
100%.
just don't stress yourself out. You won't sleep right. You won't be going to work happy. Your life will be miserable. All those things just be terrible. If those
This
things
is
that
one of
stress
those.
you out, just
Yeah.
go with a fixed rate. There's no black and white answer. It's very much of
Not
what
anymore.
your
This is one of those
situation.
cases where there is no right answer.
Yeah.
Right. There is no right answer. There's no wrong. I mean, there's wrong answers, but there's no right answer. there's what you're comfortable with. Stability, like we talked about before,
Yep.
right? Stability or pursuit of savings. One or the other. As long as you know what your goal is, well, then you can sleep at night and be happy with it. But like you said, if you're going to be up at night, there's still fixed mortgages that we're writing, and it's because people don't want to have to look over their shoulder.
So another one here, I'm going to jump into this question. There's a couple here that are really good in a row here. Do you think the housing crash will happen in Canada in 2022-23, similar as to what happened in the US in 2008? I'll let you answer, and then I'm going to answer.
No, because a lot of the impacts of these rate changes won't be felt by most people until 2024 and 2025. You still have a lot of people who are in fixed rate mortgages that will, once they expire, then they'll feel the rate increase, but not until then, right? It's affecting variable rate holders right now, but that's once again a quarter of the population, right?
Yeah.
I think once more people are affected by it, then you'll see it. As far as like a full blown housing crash, that I think is highly, highly regionalized. I think places like Saskatchewan and Alberta, however, like for instance, might actually see housing prices rise because you might see someone kick they're basically going to kick the nest in Toronto, and you're going to have all these buyers are like, screw it, I can't afford it here. I'm going to go to these smaller centers where I can buy
Look at what
something.
happened in Halifax the last couple of years. We've
Exactly.
already seen that.
Halifax is a great example.
Yeah. So my answer to that question here, do you think this will happen? First of all, often people reference 2008. That's an outlier. That's not something that happened over and over again. So pointing to a very unique point in history is maybe not the greatest example to look back on. And the lending practices in Canada are significantly different than the United States today, and even more significantly different than they were in 2008. Yes, mortgage fraud happens. I don't think either of us will say that it doesn't happen, and people will do things they're not supposed to. But the process of getting a mortgage in Canada is fairly extensive, and there is a lot of checks and balances. And I think, Conrad, you're the one that told me this. Uh, the people that do the approving for mortgages don't get fired for the mortgages they don't do. They get fired for the mortgages they do approve.
Yeah. Yeah.
So
it's good to know.
These are the people that, are supposed to be kind of, making sure things are happening above board. They're the ones who are going to get axed first if they're writing bad mortgages. Again, does it happen? Yes. Mortgage fraud happens in Canada. This is a really good question. I've seen this a lot before. I've heard people talking about a ratio. Okay, if interest rates go up a certain amount, then prices will go up or down, vice versa. So I'm going to answer this one and then you can take a second crack at it here. Yes, as interest rates go up, it changes buyers' buying power. We talked about that earlier in terms of it may reduce their buying power, especially now with it going over the stress test rate, which I've got a feeling the stress test rate is going to get changed here, by the way. That's just, I'm making a bold prediction that the stress test will see a revision here very quickly. We'll see what happens there. And the answer to that is no, there is no hard and fast rule. Like most things in life, if rates go up X percent, prices will not go down X percent. You can look at recent history where rates have gone up, let's just call it 1%. And I've heard the rules say, well, prices will come down 10%. Yet you look at recent history, we've seen three different occasions, excluding right now, when rates have gone up 1% or down 1%, and prices did not change accordingly. And it also matters where you are in Canada. Rates were dropping in some area or across the country, and yet in some places in Canada, prices were increasing, and others prices were decreasing because interest rates matter. They absolutely do, but economic fundamentals matter more.
There's a rule for every 1% increase is a 10% drop. No, I'm just kidding.
That's a bad rule. It's not a rule.
It's an inside joke. There's YouTubers out there that say that 1% increase is a 10% drop. And it's complete bullshit. It's not a real thing. Yeah, as far as like, you're right, there is no direct correlation. In other words, but there is an indirect one.
Yep.
In the sense that everything is supply and demand. No matter what product you pick anywhere in the country, or anywhere else that has a capitalistic free market, everything's always comes down to supply and demand. And anytime you have something that impacts demand, right? Yes, it does have an impact on price. It's just, you have to understand that it's not in a vacuum, that there's a ton of other factors that are also simultaneously affecting demand, right? So you've got let's say interest rates went up 10%. But then all of a sudden, we just, for some reason, attract very, very, very wealthy immigrants. We bring in 1 million very wealthy immigrants. Are you buying a home? Hell no, because the interest rates are too high. Are they? Probably, right?
Especially if they're walking in with cash, because interest rates don't change 100%, them at all.
Right? 100%. So there's a bunch of factors. It's not just an isolated environment. It's just, and then sometimes you have spillover effects where one change can actually affect other pieces of that demand puzzle that could see it. So that's why you might see, in one point in history where interest rates go up, that it actually does directly impact it because it's had that washover effect where it's joined all sorts of other things together to affect demand. But in this environment, there's, like I said, a lot of factors going on here. Immigration is a very, very big one. We're immigrating more than ever before, right?
Yep. So, and we don't build enough houses in Canada. We simply do not. On average, we build about 250,000 houses in Canada. And this is, say for the last about 20 years, that's been we've been increasing to that number. And we're going to bring in for the next couple of years over 400,000 new Canadians. So there's a lot of people that are coming here that need a place to live. Doesn't even matter if they want to buy or not. They need a place to live.
Yeah.
And we have been low in inventory prior to all of this. So there's a lot of places where we need a lot of houses. And until we start seeing houses get built, interest rates are going to dampen demand right now, but we haven't addressed the supply issue. And kind of what we saw, in the early stages of this pandemic, when things started to open up, there was all this pent up demand, people that wanted to buy houses. And there was this simmering fire of low inventory levels and strong demand that had been artificially suppressed, partially by the stress test as well. And then all of a sudden you had low interest rates, you put gasoline on a simmering fire, and it went wild. And we haven't addressed the underlying issues yet.
And the reason why I say immigration is such a notable factor, Canada domestically has, I would say, been financially mismanaged for the better part of the last 5-6 years. It's been terrible, to the point where, as far as like the G8, all those like first
you mean
world
budgets
countries,
don't balance themselves?
No, apparently not.
Well,
they do at the expense of Canadians. But they, we've performed the worst out of all the G8 countries. We have spent the most per capita and have had the
least out of it.
And the least out of it, right? Yep. From job growth, like all sorts of metrics, right? So spent the most, had the least. So that's why immigration matters. If we're bringing in a ton of immigrants that have the capacity to buy, great. If we're bringing in a ton of immigrants that don't have the capacity to buy, watch out for rent, right? Yep. So it's that's why that matters so much more. It's because we've put ourselves in a situation where we haven't managed our own finances as a nation very well.
So I hope that helps answer. Now that we've talked about interest rates, I want to get into the topic that I've been really excited about, because as much as interest rates are fun, let's talk about Epic Alliance. Dun, dun, dun.
Yeah, that's a gooder.
I'll quickly touch on it, but Conrad, I'm going to lean on you a lot on this one. So for those that don't know, Epic Alliance was a company here in Saskatchewan based out of Saskatoon. And what they offered was investment opportunities for people to either participate in flips or to buy rental properties. And they kind of had this whole system set up. Biggest thing was guaranteed returns on a couple of different programs they had. It didn't turn out very well. Guaranteed, never guarantee anything in life. Usually that doesn't work out for you. And it went really sideways for them. So Conrad, I want you to give me a breakdown. I'll give you like 2 minutes here of what was Epic Alliance, their kind of two major programs they had, and timeline of events prior to the things falling apart. Just kind of quickly explain what they were, I guess. Let's start with that.
Yeah, so they had 3 programs, but there's the 2 main ones. So the 2 main ones were essentially what they would do is they would go into a lower income neighborhood. They would pick something that was pretty torn down, beaten up, thrashed by previous tenants. They would buy it quite cheap. By itself, I mean, there's some red flags that are already there, but by itself, not bad, especially if you're planning on a flip. They would go in, they would buy it, and they would bring in an investor. And oftentimes they would either get hard cash or they'd get that investor to put their name on the mortgage. But essentially, they would say, look, we're going to give you 15% of the return or whatever. We're going to come in, we're going to do all the work and stuff like that. You just get your money.
You give them $100,000 and they turn it into 115 or whatever.
Yeah. They wave their magic wand, rub the lamp, whatever you want to say.
It was wonderful, right?
And then all of a sudden you did. And it worked for some time, right? Because they're picking really low assets. And then what they would do is they would say, well, they'd go in, they'd get an appraisal on it. And then they would go to their second program. So you have their fund to flip program, which is, this pool of investors interested in flipping properties. They would do that whole thing that we just mentioned. And then they would go to their hassle-free landlord program. And what this is, a different group of investors. Sometimes there's some crossover in the pool, but you've got this different group of investors. You can't lose money in real estate. No,
never.
No, you can. It's impervious.
Prices always go up. It'll never go down.
Hell no. How could you lose money?
What I just said.
So you have the second group of people. So what they would do is this one, they would sell you a place that they have. And they say, well, look, we're not actually going to manage it for you. But what we're going to do is we're going to lease it from you. So we're going to lease this thing from you, and we're going to guarantee you 15%. So if you have to put $40,000 to buy this rental, 20%, whatever the legal costs are, you figure out what your investment is, right? Because you got to keep in mind these were low income houses. Whatever your investment is, we're going to figure out what a payment would be, on that, and we're going to give you a 15% return. Like that's, we're going to like a 15% annual return on your investment. And then, so what we'll do is we'll lease it from you. We guarantee you that 15% because we're signing a lease saying, hey, we'll pay you. So from the investor standpoint, they're like, of course it's guaranteed. You have a lease that says you owe me money.
With a company that's been doing this.
And so, and then what they do is they go and they find a tenant and they do all the renovations on their own dime. They basically do everything. They basically are the management company without calling themselves a management company. And that's kind of what they were doing from like a 90,000 foot view. If you uncovered more of the surface, though, their programs were actually tied together a lot more than people realized that they were. So on the home buyer thing, what they were hoping on the hassle-free landlord program, how they were hoping to make money is by charging rents that were high enough to cover all the repairs and maintenances and everything else. And then that equity in the building, that was theirs to keep, right? And so that actually, like, okay, that works if the numbers work. And that's the key part, is if the numbers work. So what happened was they were taking these flips from investors in pool A and then essentially getting inflated appraisals to sell them to investors in pool B, and then giving investors in pool B their 15% return. And from what we can tell already in some of the legal stuff that's happened already, they were that 15% return wasn't actually coming in most cases from the property. It was actually coming from other investors. Right? Because the properties themselves were shit. They were in terrible neighborhoods and weren't making any money.
Now I'm going to stop you real quick here because there's one comment here that I actually missed, and I apologize. This one's a good one, I think.
There's been a couple of private lenders fail recently in the US. Large lenders have been struggling. Is there a risk of private lenders in Canada, and what's the potential impact? Oh,
it's a great question.
That's a great question. That is a very good question. That's a high level question. Okay. Yes, there has been private lenders failing in the States. In fact, lenders in the States were doing layoffs as early as January of this year. That's how the Americans knew all of the rate changes were coming in January of this year. They knew they were close because they're like, refinance market's dead. We don't need all this staff. We're canning all of these people. In fact, there's a lot of memes right now, like as to who's getting fired next, because it's that severe in the States.
Yep.
You got to know that in the States, it operates a little bit differently. They're fast and furious there. If they think they can hire 100 guys tomorrow or 100 women tomorrow to run through a bunch of loan applications and come out net positive with a bunch of profit, they're going to do it. And then they'll just fire them tomorrow. Yeah, Canada's a lot slower to grow in that sense, right? They're like, is the market going to last? Like we have this like tendency to grow slower, which isn't a bad thing. It's just different.
Market in
it's just different, right? So the States grows fast, dies fast. That's just the nature of the States. As far as private lenders are concerned, there's a caveat there because it depends on what you mean by private lending. If you're talking like the actual lenders that are like the mix, the mortgage insurance corporations of the world, if that's the case, yes and no, they're at threat. MICs are only at threat when people can't afford to pay the mortgage there's a rate of non-repayment large enough to outdo the significant interest rate they're already charging. Yeah. And so we're not there yet. In fact, I've had a lot of conversations just recently with a lot of foreclosure lawyers, right? In a bunch of different markets. And they're just not seeing anything yet. Right. Yeah. Like they're like, it might come in, 1-2 years or whatever, but the foreclosure process is a really, really long one. It's years, like 1 to 2 years. And so, we've had a lot of rate changes in the last 6 months, but you're not going to see the full effect of that for 1 to 2 years. So even if these mortgage insurance companies were struggling with these kind of payments, it's not substantial enough yet to have a big impact. And it also has a disproportionate effect on certain markets where MICs and mortgage insurance corporations, these private lenders, are disproportionately used. Vancouver and Toronto, where they're used as seconds on properties, behind, either a mortgage, like an insured mortgage of some kind. Those that's a common use for them in those markets. But in most markets, you're not going to see a high propensity of private lenders operating or suffering from this.
Yeah. And so this is actually, you touched on it here in terms of delinquency rate and foreclosures. And this is going to lead us back to Epic Alliance really, really nicely, I think, here. Let's quickly chat about the foreclosure process and delinquency. So delinquency numbers are actually really hard to get consistently,
Yeah.
but from what I have been able to get is that delinquency rates in Canada are about, on average, 0.25%. That so delinquency is when you are 90 days or more, correct me if I'm wrong, behind on your payment. So the bank is basically saying you got to start paying us, and they have to report it to the government when they're 90 days behind. And that's only at 0.25%. The worst areas of Canada are still well under 1% delinquency rates. So this is very, very low. In comparison, before things went upside down in the United States, that delinquency rate was closing in at like 3.5 to 4%. So delinquency rates were 3, 4 times higher or more, than the worst case scenarios in Canada in '08. So we're not seeing a massive surge in delinquency rates right now.
Yet.
And yet,
Yeah.
and uh, unlike in the United States where they'll foreclose on you and they'll fire sale the house, we don't see that very often in Canada. There's a whole process involved. Um, and the banks, they don't want the house back. They don't want to foreclose on you. And so even if these rate hikes push people to the brink where they're going to struggle to pay their mortgage, the banks are going to do everything they can to keep them in that house. I'll let you fire
Yeah.
away. I'm going to pull up a couple of comments here.
Well, I think you're right in a lot of senses, right? Because it works differently in Canada than in the States. It's much harder to take your home in Canada than in the States, particularly some markets over others.
And
There's
insured
certain
mortgages
provinces.
changes it too.
Yeah, like Saskatchewan is hell to do it, right? So if anyone is like complaining about the amount of documents that it takes to get to to get approved in the first place, there's a reason for that, because what they're trying to do is prevent you from being the statistic or the outlier that does foreclose, because banks don't make money on a foreclosure. Everyone's like, oh, the banks will the banks want my house because they're going to grab all my equity. In most cases, the banks do not come ahead. The banks do not come ahead in those cases. Private lenders can sometimes come ahead only because they require you to have so much equity in the property before even getting involved in whatever risky proposition you had. But that's often why private lenders are involved. But banks, they're pretty rigid, even more rigid than the States.
So this one, I had a different comment. I'm going to come back to that. I posted the comment earlier about prices. Banks, do they care about whether you go underwater in the equity position? In terms of, will they continue to keep you in the house even if you're upside down on the mortgage?
No.
Or will they foreclose on you?
They will foreclose.
If you're upside down.
Because so every time.
No, hold up. We should time out. That's if you're not paying. If you continue to pay the mortgage, they don't care if you're upside down on the mortgage at all.
100%. No,
they do not care at all. It's
and that
only
actually
if you stop paying.
That's right. That's actually a really important distinction, because it goes into what I was just about to say, is that banks, when they have these mortgages, they have payments on their back end that they're making. So you go ahead, you pay the mortgage, and they go ahead and pay whatever investor that the mortgage-backed security or whatever that it's tied to, right? So there's a flow of capital, and you stop making those payments, they still have to make theirs. And so it puts a strain on their capital. So even if they're going to lose money by taking over your house, they're going to do it because they want to stop the bleeding. That's their incentive. That's their goal. If you're underwater, but you continue to make the payments,
they're going to let you do it.
Everyone's going to hold hands around the campfire and sing Kumbaya.
And so we'll quickly talk about the foreclosure process, and then I want to get back to Epic Alliance here. And so the foreclosure process in Canada, for those that don't know, is a very long process. Like a year pretty much is minimum, unless essentially the owner just says, here's the keys, take my house. But if the owner is trying to make payments, and usually they'll go to court, and then they'll say, okay, you have to pay. They'll make plans. And as long as that owner continues to make payments on accordance to that kind of court-ordered plan, the foreclosure process will not move forward. If they slip a little bit, they'll start the foreclosure process again. But if they catch back up or they start making payments, it essentially just restarts the clock. It is actually really, really hard to foreclose on a house in Canada to begin with. And then even when the house gets foreclosed on, this is kind of maybe a TV misnomer. Generally in Canada, these are not fire sales. It's not like you're buying a $500,000 house for $100,000. That essentially doesn't happen in Canada.
No.
And a lot of this, because if you take an insured mortgage, for example, the lender has to prove that they went out and tried to get fair market value and still lost money to trigger that insurance policy. If they just go fire sale it, the insurance company says, sorry, that was your choice to fire sale it. We're not paying out the insurance policy. So I'm going to quickly let you jump in on that. And then I'm going to start getting back to some of these questions here in terms of what the foreclosure process is, how long it takes, and actually how rare foreclosures happen. And they're not really fire sales.
Well, actually, while you're doing it, hit that comment, the second last comment that says, then it would be smart from a homeowner's perspective, because that ties into what I'm going to say. Yep. It does depend. Here's where the problem is. A lot of people say, well, I'm underwater, so I should just stop paying my mortgage and walk away. There's two consequences to that. The first is that that's maybe less obvious or maybe more obvious, depending on your perspective, is you got to live somewhere.
Yep.
So you're probably going to be going to a place that has higher rent, most likely, or maybe not. But where are you going to live, right? So it might be worth it to pay underwater. The second more severe reason why, and you're going to want to get professional consultation if this actually becomes a real.
Don't take this as advice for your situation, guys. Here,
yeah, because there's all sorts of nuances.
Very much in generalities here. If you're underwater, you're upside down. You got to talk to a specialist in that area. Don't listen to our blurb on YouTube.
Reach out to me. I don't care, right? And so I'll help you. But the second thing is you got to be careful, because just because you're underwater and you decide, yeah, I'm sorry guys, I'm walking away, right? The bank, that's your problem. No, they can actually try and sue you for the difference.
Yes, they can.
Right. And so it's like, now you owe us 30 grand. They don't stop collecting because they own your home now, right?
No, they keep going.
They'll
take your house and they'll sue you.
So then not only do you have a foreclosure, but you have a bankruptcy on it as well. So, there's more reasons why there's more reasons why you might want to do it. But like I said, there's so many nuances to it that you got to be cautious. And by the way, make sure that the person you are talking to is good at this, because I have seen on a number of occasions, people take their case to a lawyer that pretends to know what they're doing or whatever.
And lawyers are smart people, but they might not specialize in this. So
I've straight up seen people sue lawyers because they screw up so badly and they have nowhere to turn to. And so you got to be really, really careful, because whoever you're getting your advice from your, especially with this, there's so many ways to get it wrong that you need to make sure that you're going to the people who are actually going to do it right.
Okay, so here's one. Wondering about negative repercussions, especially for those people who paid 5% down. I'm Breakthrough. I'm going to ask you to add on to this comment in terms of what you're meaning by negative repercussions. I'll start on this and I'll let Conrad kind of finish it off, and Breakthrough, if you can jump in and give us some more feedback here. In terms of if you put 5% down, and I've had people call me, for example, say, oh my God, my house has declined in value. What do I do? Well, do you plan on moving? And if the answer is no, I like my house and I plan on living here for a while, do nothing. Continue to pay your mortgage. Live in your house. And it really doesn't matter if your house declined in value if you're planning on living in it, because you only lose money or gain money on a house when you sell it or when you buy it. So, unless you're leveraging against it, again, that's a whole different ball of wax. But if you just have bought your house and you're going to live in it for the next 5 years and it dropped 10%, it means absolutely nothing to you unless you plan on using that as a leverage. But if you're just living in it, paying off your mortgage, kind of doesn't matter. For those that put 5% down, yes, obviously, if prices have declined significantly and you haven't paid very much that principal off, you could be upside down on that mortgage. So Conrad, I'm going to let you
actually
on that.
hit that next one by Breakthrough. Just so that's on the screen. If you put 5% down and you saw any decline, you're underwater. Because the insurance, the CMHC insurance, the Sagen insurance, Canada Guarantee, doesn't matter which one, is over 4%. Yeah. So if you saw, when you actually
when you bought your house, you owned 1% of it. You owned the bathroom.
It's actually less than 1%.
You own the countertops.
That's right. It's less than 1% because your actual loan to value is like 99.2 or 99.4, whatever it is. So it's less than 1%. And so any change in price, you're going down, provided you sell, which, if you are in that situation and you're like, man, I was hoping to sell, then why did you buy in the first place? Right? You should, in my opinion, you should never be buying a home if all you intend to do is own it or live in it for 2 years, right? Like, unless you have the desire to convert it into a rental or whatever, but you don't want to do it. And as per your other comment there.
Yeah, this is a great one, and we're going to jump back in the one above it, but this is really good.
CMHC insurance protects the lender. It has nothing to do with you. It's mortgage default insurance. Yeah. So it protects the lender in the event that you default against it. And some lenders trying to look for a competitive edge never put in a claim, but it in no way saves your butt.
Really, what mortgage default insurance does is, because the way our rules are structured financially, you have to put down 20% when you're buying a house in Canada. But if you don't put down 20%, you can put as low as 5%. You have to have mortgage default insurance. That's a requirement, like full
as
stop.
Of decades and decades ago.
There's no way around this type of thing. And so that's how this system has been set up here. Originally, CMHC was the only provider of this, which is why most people will call this CMHC fees. Nowadays, there's two private lenders or two private
that are actually bigger, by the way, than CMHC.
Both of them are bigger, yes, than CMHC. Now, CMHC 2.5 years ago was by far the market leader, and they changed some lending practices in 2020 and essentially destroyed their market share. They went from roughly 50% market share to, I believe, they're about 25 or 30%. So they killed themselves.
And it was a pretty minor. Is the largest by now.
Sagen is the largest, yes. So yeah, CMHC doesn't give you any protection as a buyer, other than it allows you to buy a house with only 5, 10, or 15% down. Anything less than 20%.
Yeah, and it was originally created to save the market in the event of a downturn.
It was designed to
so that you didn't
stability.
Have a bunch of lenders losing out on like the financial markets crashing because you had all these lenders losing out. There was some kind of insurance in place to protect against that downturn.
This is a really good question here.
If interest rates go up, will the bank come and pay the price difference for the drop? Even
ask to pay.
Yeah. Oh, sorry.
They're asking. So if you, for example, if these interest rates go up, will the bank come and ask you to pay the price difference for the drop in value, even after paying the mortgage on time? No, the lender doesn't care what goes on in the market in terms of your house went up 10%, 20%, or down 10 to 20%.
I see the question.
As long as you continue to pay your mortgage, they don't care what happens really with the price of your house at all. It doesn't matter to them. When you go to sell that house, so we're going to use really simple numbers here. You bought the house for $100,000 and it dropped down to $75,000. Your mortgage that's outstanding is $85,000 because you've only paid off $15,000 roughly in the time you've owned it to when you're selling it. You have to write a check, though, for the difference of what your mortgage is left versus what you sell the house for. So again, if you sell the house for $75,000, you have to write a $10,000 check to your bank to sell your house.
The other thing that's notable here is it could impact renewal.
Yes.
If the house price is substantial enough that the AVM's automated valuation models pick up that your house is now worth less than the mortgage, and they're conservative numbers, but I like don't get worried about the complexities of it. But if they determine that it's a substantial enough drop, you might see it impact your renewal in one of two ways. One, the lender could realize, we don't want to be in this position, so we need you to put more money down so that we're not so underwater. We'll still lend to you. Or
basically, you have to put a down payment down again on the house you already have.
Basically, they might ask for that. They might also, though, say, we're actually not, or we will renew you, but we know nobody else will at these rates. So what we're going to do is we're actually going to give you a higher rate because now you're stuck. At risk.
This happened a lot when the stress test came in. This was kind of a deal that the banks and the government did, and it was a deal with the devil. I'll say it the way I think it is, and that is a lot of lenders knew that there was a certain percentage of homeowners when the stress test came in that would not qualify. So for those that don't know, when you renew your mortgage, if you renew with the same lender, you don't have to requalify under the stress test. If you switch lenders, you have to qualify under the stress test. So a lot of these banks kind of did their numbers and went, okay, I know Conrad's will not qualify with another lender on this property, and they'd stick you with an ugly interest rate because you didn't have a choice.
Yeah. Well, believe it or not, you actually did have a choice if you were informed. So, which most people weren't.
This is why I bring Conrad on.
Yeah. The rules were actually that you could grandfather the previous rules. So had you been approved under previous rules on your switch transfer, on your renewal, you could actually grandfather that existing thing if you knew to request it. Most mortgage brokers didn't even figure that out for the first 2 freaking years.
Yeah. Right? This was I'll call it a backroom deal that was done. And the government basically said, we're going to put this stress test in.
It was a terrible rollout.
Lenders, you are going to take a hit on this. We know it's going to hurt the market. It's going to drop sales. So basically here is the compromise.
I don't even know if it was intentional though.
It might not have been intentional. I just feel like it was one of these things where it seems like something they would do.
Because they, like I said, anyone could have grandfathered it and gone anywhere and then said, well, you don't qualify. It actually doesn't matter that I don't qualify. I'm grandfathered in under the old rules. And in which case they go, okay, fine, great. Any new application that wouldn't have affected, but the rule existed too. There was something in there, a caveat in there to protect you. We did it all the time back then. But a lot of people totally missed it and then ended up getting higher rates because they had no idea it was a thing, or their broker had no idea that it was a thing, right? That's information is power in this game.
Okay, so mortgage insurance is added to the mortgage amount. So the total insurance you pay is subject to your mortgage interest rate, or is it just insurance amount principal added to the mortgage principal? Conrad, fire away.
Sorry, I got to read that again. I got distracted by the spam comments.
Yeah, I'm trying to get rid of the spam comments. The click this for nude photos type stuff. I'm working on that, guys. Here.
Mortgage insurance is added to the mortgage amount. So the total insurance you pay is subject to your mortgage interest rate, or is it just interest? No, yeah, you pay interest on the premium.
Yes. So when you buy a house, you spend $100,000 and the insurance premium is $25,000. We're making up numbers here, guys. But it basically, your mortgage, you take your down payment out of what you put down. So if you put down 5%, buying a $100,000 house, you back out $5,000. Then you add the $25,000 on. That's what your mortgage starts at. Again, those are bad numbers.
And believe it or not, in some provinces, not only do you pay interest on the premium, but you also pay a tax on the premium. So how's that for a kick in the nards? You pay interest and a tax on the premium meant to cover the insurer.
Here's one you're going to love and fears. This is one I think you'll like as well. When you have land transfer taxes in Ontario, for example, in Saskatchewan, we don't have land transfer taxes. Don't tell anybody. It's awesome. You have a provincial and municipal land transfer tax in Ontario, and I believe it's the municipal land transfer tax you pay, which is substantial. Like we're talking tens of thousands of dollars on properties here.
Without the exemptions, yep.
They charge you a $90 administration fee and then GST on top of that.
I guess so stupid.
So they collect tens of thousands of dollars from you, then charge you administration fee and GST, PST, or HST, I guess, on Ontario on top of that. That's a kick in the nuts, we'll say.
Yeah, that is.
This one, speaking of someone who knows a ton of people who managed to get around the stress test, including a friend of mine who has no income, I'm wondering your opinions as to whether it did any good. Now, this one to me seems interesting. I'm not doubting you here, but I don't know many people that have managed to forge that amount of paperwork having no income at all to buy a house. That would be really surprising without a mortgage broker fudging the paperwork as well. And
there's net worth programs that don't necessarily require you to have income.
Yes.
So
yes. There are retired and stuff like that.
There are programs that do exist for it. It is unlikely that these people did actually get around the stress test. What is more likely is that they put a bunch of money down against their house, predominantly more than 25, possibly even more than 35% down. That's most likely. And as a result, the stress test was nullified in the sense that typical ratios are there's gross debt service, GDS.
They put so much money in, it didn't really matter.
Yeah, like 39 and 44 are the ratios when you're underneath that, underneath 20%. But the moment you're above 20%, those ratios matter less. So the stress test by default also matters less, right? Because it's like, oh, you have all these debts. Who cares? The ratios still work. So the stress test still existed. It just didn't exist enough to matter. So that's my guess is what's going on there.
I hope that helps there. We'll get two questions here we're going to get to that are both really good here. So paying 20% basically saves you a significant amount on the total purchase value. Yes, basically, if you can put down 20%, 9 times out of 10, Conrad, that's the better option if you can do so.
Last year was an exception. Last year, the rates were substantial, like the rates that you got, because you get a higher interest rate when you put 20% down, because it's no longer insured as of
typically that changes at about 35%. You go back to better rates again, correct?
That's right. And I had a whole video on it where I talked about like how like last year that said like 15% made the most sense, and at that time it did. Present day knowledge with the rates so tight together between what you get for high ratio, which is less than 20%, and conventional, which is 20% or more. Those rates are so close. If you can get to 20, great, do it. As long as you're not putting yourself in a cash strapped position where you have no safety net. Right?
Yeah,
That's
20. If you can put down 20%, it's better. But if it's a position of, if you put down 15%, yes, you're going to pay a premium on that. But if that leaves you an extra 5% to do repairs, renovations, that type of
survive.
flexibility, survive. Yeah, it probably makes sense in that situation, which is why I think that's probably most the theme of this conversation is there's no hard and fast rules. There's no like, this is an absolute must. Everything is so situational on this. And that's why you want to sit down and talk with somebody like Conrad here about your specific situation. I'm going to jump to a couple other questions here. These guys are awesome, guys. I really like
Those
your
are really
questions,
good
by the way. Like,
questions.
keep going. Like, we'll be here and we'll answer as many of these questions as we possibly can for you here. Let me just pull this up. Here's one. I don't think we're going to be able to get you an answer to this, but let's have some fun with it.
So, in the case of Epic Alliance, no, I'm just kidding. That's not, no. What is the percentage of mortgages that are fraudulent? I actually don't know the number offhand. I do, however, know that it's significantly more than people realize. I actually sit on a few boards that have like national exposure or whatever, and this often has come up. So I'm sorry, I'm blanking on the number, but it's often investors or mortgage brokers that are doing the fraudulent activity, right? So even sometimes mortgage brokers are heavily involved in this, trying to help skirt the
Yep.
system. And it depends on what you mean by fraudulent. So outright fraudulent, like there's different types of fraud, right? So like if you put a mortgage on a land and say, yeah, there's a house there, but there's no house, that's called an heir loan, right? Which
It's
is
Epic Alliance. We're going to get to that one.
in some cases,
It
yeah.
may have happened in
Yeah,
Saskatoon.
it did happen in one case, apparently. But well, I don't know if the mortgage was involved in that, but the investor was involved for sure. But yeah, like fraudulent, for instance, some people, for instance, depends on what you like I said, what you decline as or declare as fraudulent, because some people say, oh, I'm planning on living in this house so
And
that
then
they
they
can get the
don't.
better rates, and then they turn it into a rental
Yep.
instead, so they don't. That's called occupancy fraud. So technically, by the very definition of the word, that is a fraudulent mortgage, in which case the percentage is far more than is being reported. But if you're talking about like actual nefarious activity where they're not just trying to dupe it in the sense that they're trying to get a better rate or
They're
whatever,
just flat
just
out
straight on
lying.
fraud, I don't know the percentage offhand. It's
Okay.
lower though.
This one is one I'm really that we could dive into this one a lot. Do you think the future of real estate will be more transparent with bidding issues? So I'm going to start on this one and kind
Yeah,
of
have
let
at her.
you pick away at this. So first of all, let's talk about why. And I'm assuming here we're talking about blind bidding here, and feel free to correct me here if I've missed the question. Blind bidding was actually originally put in because buyers, there was a big push towards the regulators saying real estate agents aren't treating us fairly. They are playing ends against the middle. They go for, okay, buyer one offers $100. Okay, buyer one, you offer 100. Buyer number two, the new price is $100. Oh, it's 110. Okay, going back to buyer one now. New price is 110. And they would play this game back and forth essentially until somebody called uncle. It became an auction. And so the idea was, no, we are going to prevent realtors from disclosing the information on how much people are offering so that each buyer basically can put forward what they feel is right and then let the chips fall where they may. So that's where blind bidding comes from. This was actually put in by real estate regulatory bodies to protect buyers.
Yeah, and if you look at other countries like Australia that has open bidding, because there's other countries in the world that do bidding differently. The What's funny is there was a longer term study that was done, and basically it was called bidding equivalency. Basically, it didn't matter what system that you had; it all roughly ended up being the same. Like, and they did the study with like they did Australia, they did the Canada, the United States part of that study. So it didn't matter which of the systems you use; it all roughly ended up being the same price for that house, give or take.
I'll talk some real world examples. We see the news, for example, where you hear of one guy paid like $200,000 more than the next best guy. Yes, that happens. From my experience and talking not just my own business, but talking with other agents across the country, if you see 10 offers on a property, here's typically they follow. Again, this is blind bidding where nobody knows. And I'll give you a real world example of one I was involved in. 10 offers come in. There's going to be one or two that are just like make no sense at all in terms of they're well below what everybody else is. Then you're going to have a chunk of them, like 5 or 6 of them that are all kind of clumped together, or even more often, it's like 7, 8 of them. They're all clumped together that are all about the same price. And then every once in a while, you get the one wild card where somebody puts in some stupid number. And that's the one we hear about in the news. But more often than not, those all clump together. So, real world example, I was helping buyers, they're buying a house, and the asking price, and this was, I feel, maybe put in artificially low, something that buyers get frustrated with, where sellers will put a number on it that they have no intention of accepting in order to get a bidding war and more activity and a higher sale price. So, anyways, that was listed like $540,000. I told the buyers right off the bat, guys, this is not a $550,000 house. It's not a $550,000 neighborhood. This neighborhood starts at 600 essentially all day long. So, unless when we go to this house, there's something absolutely ridiculously wrong with this, which I was pretty sure there wasn't, knowing the agent and the photos that were available, even before going to look at it, said, unless you're willing to spend $600,000 to buy this house, let's not go look at it, because it's going to sell for 6 something. When offers came into my eyes, decided to write an offer, there were 9 offers. 2 of them were that 550-ish, just over asking price. And of the remaining, so 7 offers, all of them came within like $10,000 of each other. So 7 independent buyers with 7 independent agents all came to the same rough valuation.
Right. Which goes to Sean's comment there. Property is worth what a buyer is willing to pay.
Yep, absolutely. But I'm going to quickly touch on some more transparency. One, I am all in favor of providing transparency. The challenge becomes is, what's the balance? Because we have to make a market that is fair for buyers and sellers. And right now, or recently, the market has been skewed towards sellers, and it's not necessarily been fair for buyers. What we're seeing right now, just the market itself is kind of taking care of some of this problem. Like, if you notice, nobody's complaining in the last 2 months about blind bidding. All of a sudden that stopped because prices aren't crazy and we're not seeing crazy demand anymore. The idea of underlisting a property to get bidding war, that stops as soon as the market starts to stabilize. So you only see these crazy problems when the market goes insane. Outside of that, the market tends to function a lot better.
Right.
But yes, more transparency. I know that there is a system coming into Canada at some point here. It's called Open Offers. It is from Australia, where they're going to provide real-time pricing information as offers come in. I'm kind of excited for that.
That's cool. Almost works like an escalator clause. I haven't heard of this yet.
Escalator clause is something I would love in Canada. Absolutely love it. I'll touch on that in a second. But basically what they're going to do is, okay, when offers come in, they're going to be published. Now, they're trying to figure out exactly, are they going to publish the dollar value, or they're just going to say, buyer number A, you're the highest. Okay, now you're the highest. And so you as a buyer will know whether you're the highest or not.
And you can change your bid?
You can then change your bid, and basically it becomes an auction, which
I'm not sure. It's like those little systems that you used to buy like online, where you just keep clicking until you're number one.
So I'm not sure if that's better for buyers or not. I don't think so. That's my personal opinion, that it's not better for us. I understand the comfort factor going, okay, I know that this guy paid X amount and I wasn't going to pay that, and you feel better about yourself. I understand that desire. I don't think it actually makes the house prices cheaper.
But I think escalator clauses are insulate the buyer and the seller way better. I think that's just an overall better system.
Escalator clauses, I love them. I wish we could have them here in Canada. So basically, the escalator clause works is, Conrad says to, he's the buyer, he goes, okay, I'm willing to pay $500,000 for this house. But if there's multiple offers, and only if there's multiple offers, and there's a whole registration process involved. So you can't fake offers. There has to be offers in place, and you can request to actually see the proof of the offers. There's a process involved. But Conrad will say, I will pay $500,000, but I will pay $1,000 more than the highest price, up to $550,000. So if 2 more offers come in and the next best price is $525,000, Conrad would get the house for $526,000. So he, as a buyer, knows he paid only $1,000 more than the next best offer, and the seller knows they got the highest price they could have got, because literally people said, this is the most I'm willing to pay.
Yeah, it's a brilliant system. They do it in the States.
Yeah, I really, really like it.
Yeah.
That's okay. A good one. We'll get some more questions here, guys, and I hope that's answered some questions there. Let's go to this one here. What's average cost of mortgage default insurance? Conrad, you want to run through it in terms of 5%, 10%, 15% down?
It's real quick. All that happens is it changes based on how much you have down. Once you hit 20, it's 0, right? And when you're at 15%, I think it's like 4.6 or 4.2?
I think it's 5. When you have 5% down, it's 4%. When you have 10,
4.2, I think is what it is.
yeah, when you have 10% down, it's like 3.6, and I think it's
Yeah.
2.6 or 2.8 when you have 15% down.
Yeah. So it changes.
It's a sliding scale.
The biggest jump is when you go from 15 to 20.
Yeah. Okay. So we're going to get back to this breakthrough. Speaking of Epic Alliance, alleged real estate fraud, we are going to talk about that. We're going to answer a few more questions. We'll circle back to this here. Let's see.
And it's not alleged anymore, apparently.
It's not alleged. Has it been? No, it hasn't been tested in court yet. So I believe it's still alleged.
Oh, I guess it's still alleged. Yeah, that's right.
So we have to go with that. Will the Bank Canada be able to hold start over there? Bank Canada be able to hold the rampage these higher interest rates can create for the economy? Boy,
what do you mean by rampage, though?
Come back to that. Please kind of fill us in on exactly what you're asking. We'll come back to that here. Here we go. Do you know the number of second homes investor properties in Canada or region? Thoughts on these filling some of the supply issues, especially as investors have less risky options. So, Conrad, fire away, and I've got some information that we'll chat about.
So, thoughts on filling some of the supply issues, especially as investors have less risky options.
First off, total number of second home investor-owned properties, stuff like that.
I don't know those numbers offhand. Actually, I'd have to check it out.
I used to know and I forgot.
Yeah, as far as my own book of business is concerned, it ends up being about 20%, 25%. Second homes less so. Second homes are much less. That's like sub 5%, but the investor owned homes, that's 20, 25. Because what makes that number tricky is, is it the number of investors or the number of homes? Because one investor might have 100 homes, but you might have 100 investors with one home. So do you count, depends on what factor you're looking at. Or are you talking about the number of investor owned homes? That's a totally different number than how many investors own homes that are in that situation, right? So I guess it'll depend on what question you're asking, but I don't know the number off the top of my head for either of those. My guess is it's somewhere in the neighborhood of well, it would have to be at minimum 33% because about a third of the country rents. So it has to be at least a third of properties out there that are rented. It's as far as how many of them are investors, I don't know. But as far as the supply issues, man, there's so much red tape to build stuff like that. There's a lot of misnomers about what it takes to be a landlord, what it takes to be, and there's a lot of people who crap on landlords and be like, oh, they're making all this money on the back of renters, and oftentimes that is not the case. Not most landlords are not these big conglomerates that people talk about, which I don't even know what the hell they're talking about 90% of the time, or on the news and stuff like that. Most of them are mom and pop shops, right? They're your average everyday family with two kids and a dog that own this rental over here or that rental over there. It's not like these big corporations that own them, right? A lot of the times you have taxes and everything else that strictly target those people. So they don't really have an incentive, but that doesn't handle the supply issue. Supply doesn't come from someone buying a home and flipping it and making it better. Well, that's such a small element of supply.
Even if they're owned by an investor, they're going to rent it out. So it doesn't matter whether it's owned by investor or end user. It's still
one home, one person, right? Supply changes when you build more homes.
The other part too is second homes. This is a number that gets thrown a lot. I can't remember the numbers, but I've seen headlines of X number of Canadians own second homes, and people assume that means, they're rental properties. The actual answer to that question is most of them are vacation properties. These are people that own cabins and things like that. And for example, there's a headline, I've seen it out a gazillion times about how there's about 1.8 million vacant homes in Canada. This was a Statistics Canada publication.
Oh, I hate that stat.
I hate it. And that's why I'm going to want
so misguided.
I know. That's why I want to touch on it real quick here, because I think it's going to answer some of the questions here. So the number was 1.8 million homes. First of all, the headline is basically pulling data that is not really, you're not understanding, I guess, what Stats Canada was trying to report. Yes, that there is 1.8 million vacant homes. But for example, of that 1.8 million, something like 50% of that is properties that are sold, awaiting the new owner, for sale, awaiting a new owner, rented, awaiting the new tenant, or for rent, waiting for a new tenant. So those are just normal properties that are in the process of going through a transaction of some sort. Then a huge percentage of that is, of course, vacation properties, because if the person is not there when Stats Canada sends the information, they count it as a vacant property when it's a
Yeah. Are
cabin.
you living in your cabin? No, I'm
No,
not.
and so that the other part of it too was the timing of the study, which was done in May, for example, and so these would have went out right when students were leaving their rental properties. And
Yeah.
so a
It's just
bunch of
like,
properties that were vacant because the students had just left were counted in this study. And as well, when the studies went out, because the way that the question was asked is, um, does the owner also, are they also the primary occupant of this? So, for example, a student may say, no, this isn't where I normally live. I live at my parents' house. And so then that house, which is occupied by a tenant, a student going to school, was considered a vacant property. So a whole pile of these vacant
yeah.
properties were just really badly reported. Um,
Well, and it's just anyone who does statistics for a living should have known better. It's just a crappy study.
well, I think the way the question was asked was part of the problem. The question was asked in a way that basically said, "Is the person that's living here today, is that the primary owner of the property?" And so students would answer, "No." Or, "Is this your primary residence?" And people with vacation properties would answer, "No, I live on 123
Yeah,
Main
like I
Street.
said,
This is my cabin."
sampling was terrible,
Yeah.
timing was terrible, wording was terrible. It's just
So
terrible as a whole.
Okay, property prices in Canada on the rise for the last 30 years. What do you think the value of the average house in Canada? Well, prices have gone up for a couple of reasons. One, we don't build enough houses and we have an issue of supply and demand imbalance, but also prices have gone up because your dollar has been devalued because of economic policies.
Inflation.
So a huge percentage of, I'm not a huge percentage, but a percentage of the rate of price appreciation is simply the fact your dollar is devaluing. I saw really cool numbers. I wish I remembered the exact numbers, but it was, if you priced the price of gold to buy a house, how many ounces of gold you need to buy a house in like 1970 versus today, that number hardly changed at all. It's the value of your currency that dropped.
Yeah, substantially. And it's your income that hasn't kept pace. Everything
Yes.
else has.
Okay. What's the best way to determine the average price of a neighborhood in order to determine what the owners are really asking? This is one. Talk to your real estate agents. Any real estate agent worth their salt is
Should
going
know
to be
that
able to
answer.
tell you, hey, here's what this neighborhood. So, like I said, I had that client where I told him, look, at guys, this neighborhood starts at $600,000. What this house is worth is going to be six something. It's our job to investigate it once we go there and figure out kind of where this sits in the neighborhood. So asking prices are literally just a number on a piece of paper. They don't mean anything. You, as a buyer, in conjunction with your agent, you'll be able to do the research and go, okay, here's what houses are selling for, both historically and right now. What are people asking? What are people getting? So, the best way to determine the average is sit down with a really good real estate agent, and they're going to be able to say, not only here's the historical prices, but like, here's what we're seeing in the market. Here's what this neighborhood will typically sell for. The good ones will tell you that right away.
Hmm. For sure.
Okay. Oh, this one's one I really want to touch on. Why can't the government subsidize housing developing by working with developers to
That's a
increase
great
supply?
question.
They don't want to.
Yeah. Great question. Why can't they?
Why can't they? Because they don't want to. So here's the thing. I'll be a little bit negative on the government, we'll say, and Conrad, chime in when you want. The government and our elected officials, bless their heart, a lot of them get in for good reasons, but they think about election cycles, which are 4 years or less. And
this is federal and provincial. We're not picking on any
municipal.
party and municipal. We're not picking on any one
Any
party.
party, anything like
We're not
that.
picking on any one
They're
province. This is literally all of them.
they're thinking in a 4-year cycle. And to fix our current crisis we're in, we realistically need a decade or two of massive increase in building. So they can make a promise, we're going to build X number of houses. They're likely not going to see the fruits of that hard work for a decade, and they're not even in politics anymore. So they're going to try to put a band-aid solution, something that fits really well on a hashtag that they can put on Twitter or on a banner of a podium and say, look at, we're doing something.
We're fixing housing.
And do nothing.
Yeah. Because if you think of it, like think of a development from start to finish. They got to buy the land. They got to get it approved. They've got to service the land and like actually get all the services to it. Then they got to build on it. By the time you grab a piece of land and turn it into something that you can, like a homeowner can actually walk up, put their key in the door and move in, you're talking at minimum 7 years, 7 to 10 years. And so even
for a big
worse,
project, but even for like a house, you're the better part of a year. If you said today, I want to build a
house. But that's
a
service lot already, though.
Yeah, that's
my point.
Yeah.
Like, but if you're talking about actually functionally increasing supply, you have to actually keep that development in there as well, which is years.
Yeah.
So even then, so like to your point, yeah, they're not going to be able to take credit for it. But even worse, whoever follows after them, which is likely a different party,
is
going to be like, credit. Look at all the housing that I've done. Like, I'm amazing. I've increased housing by like 20%. Meanwhile, it's all work that had been started 7 years ago.
Yep. So that's a huge part of it as well. And then the other part of it is that you've got 3 levels of government that kind of have different priorities, objectives.
And don't talk to each other.
And they have different things they're in power, they control. So the federal government controls immigration, population, basically. And the municipal governments are the ones that issue building permits. And they don't always talk to each other. And they also have potentially different voter bases. You look at municipal elections, when you have 20% voter turnout, guess who turns out to municipal elections? Homeowners, older, wealthier. They don't want something that is going to devalue their property. That's who votes in municipal elections. So
they don't want a fourplex next to their nice garden.
So here's the answer to that. Get out and vote a whole lot more, and we'll hopefully see some changes. But I digress. I'm a political science guy, so that's my political.
That's a whole other video. We can go for an hour just on that one.
Okay, so here's one. I think we've both got a similar answer. To jump on this, the other previous question here: if interest rates rise trigger recession, do you think the Bank of Canada will balk at these increases and start a decrease?
No, flat at best. Only, I mean, maybe they'll make some modifications, but it depends on who is or what their biggest devil is, because they still have to combat inflation, and if they don't combat inflation, the problems will be far worse than the recession.
And unfortunately, this some Conrad and I were talking about this morning, is that a huge part of inflation right now is comprised of 2 things: the cost of energy, so fuel, natural gas, things like that, and groceries are a huge part of what's causing inflation beyond the supply chain issues, which are another huge component. Yeah. And interest rates don't care about the cost of natural gas, and the Bank of Canada can't touch that. So they can raise rates to 5,000%, and it won't change that you're still paying $2 a liter for gasoline.
So and think of it this way too. The Bank of Canada knows almost certainly that a recession is inevitable in this case. Look at just naturally, our CPR, our inflation is very, very high. To bring it down to its target level, okay, if that's the goal, to bring it down to its target level, that dramatic of a change has never in Canadian history been done without triggering a recession. Not once. That change in CPI, anytime the CPI is dropped by that measure, 5.7% to go from 7 to 3 or whatever, 4 or to 2%, that change has never been done where it has not triggered a recession simultaneously. So the Bank of Canada knows that they're triggering a recession. They know it.
Yeah.
It's just how severe of a recession they're going to do. So as long as that recession isn't severe, then they're going to keep fighting the battle for inflation. If the recession becomes severe enough and we start seeing a stagflationary environment where you have both inflation and recession, that's a whole different ballpark.
Conrad, here's one for you.
What do you think about becoming a mortgage broker in this market and what's to come? Well, do you see this? I'm going bald because every day I just sit there going like this. No, that's a good question, but I'm going to do you one better. I'm going to say, if someone actually has questions like that, just reach out to me directly. I think Matthew's got my contact information.
I forgot to put it in the description, but I will after this. I will put Conrad's contact information, and he'd be happy to chat with you, Alex.
YouTube channel if you could as well.
Yeah, I will.
But yeah, Alex, it's great. You can make money as long as you know what you're doing, but it's difficult to know what you're doing. I guess there's a lot of people who don't know what they're doing and they're still making money. So what the hell?
Okay. Besides the first time for a 5% scheme, what are the benefits of a first-time buyer can avail themselves of? A couple of programs. It's a lot of people think that there's a red carpet rolled out for first-time home buyers, and whether there should be or not, that's a different question. There's not really, besides the 2, and I'll talk about them. Conrad, you can finish it off. There is the first-time home buyer plan, which allows you to use RSPs as part of your down payment, and the first-time home buyer incentive. Go.
I'm going to start with first-time home buyer incentive. Oh, what a useless program.
It fit really well in a hashtag and on a slogan, and that's why the government loved it.
Oh, and the way the media just floundered over it, like, oh, it's the best thing. Like they're doing something about, like, it was all talk, all smoke and mirrors, no substance. It was a failed program that the NDP had done out in BC. It didn't work. The federal government, our federal government, looked at it and was like, wow, that shitty program failed. Maybe if we put it across the country,
it'll work better.
It could suck across the country. Like, I don't know what the rationale was. So they rolled it out. They've made so many modifications.
Tell them how the program worked in the first place. Quick one.
So first of all, you still needed your own 5%. So what
you had to have the down payment. Yeah.
What the hell was the point? So
it didn't give you a down payment.
No, all it did was like, oh, okay, you got your 5%. Great. We're going to give you an additional 5 to make your payments better. Oh, okay. Thanks. By $100. Woo. Yeah. Right. Like, that doesn't make it qualify for anything.
Yeah. So just so everybody knows, it didn't change your qualification in any way, shape, or form. You had to qualify all on your own. So if you weren't qualified to buy a house, first time home buyer,
in some cases it did, but it mattered none. Like, it mattered so little.
Yeah, basically nothing. And what they would do is they would take, if you had a 5% down payment on a resale house, they would grant you 5%. They would loan you basically 5%. New construction, it was 10. In exchange, they took an equity stake in your house.
Yeah.
So that meant when you sold it, or 25 years, whichever came first, you had to then repay 5% of the value of your home back to the government. But as well, you couldn't have a household, not individual, a household income, I believe, had to be less than $120,000, 150 in some cities. They increased it. Vancouver, Toronto, Montreal, Ottawa.
That was a modification made later.
Yeah.
Yeah.
But yeah, household income of $120,000, and your max purchase, I believe, was $480,000. So again, and they bumped it again in Vancouver, Toronto, Montreal to, I think, 750.
What a dodo bird.
It basically didn't help anybody. And that's why there was essentially no uptake.
Like, when it first came out, they by the way, when they had consulted, professionals and stuff like that, like, people in our industry, and then totally didn't do anything was said at all. Like, they ignored everybody. And then when they rolled it out, it was like, okay, we did it. And it's like, oh, what the hell? Oh, we're doing this now. Okay, now we got an FTHBI. That's great. It's like, no idea that this was actually coming down the pipeline. But what was worse than that? When they rolled it out, it was literally the stupidest thing. Like, right from the start, you're like, this is dumb. Who in the hell would ever want this program? And then they made modifications to it, and it still sucks. The uptick is so bad that I think even after all these years, they still haven't surpassed 10% of their original year one number.
I believe I saw something ridiculous. Like, the number of people that used it in Toronto was like 6. Like, I'm not even kidding. Like,
it was low. Yeah. Because it made no sense. It was so stupid.
I think the biggest city in terms of user base that used it was Edmonton, and it was like 1,800 people used it. Like, that's how low this program is used.
Yeah.
So then quickly, but the one that I like, and I think you like it too, the first time home buyer plan. So without the incentive, the first time home buyer plan, which allows you to use RSPs as your down payment. I really like it. I think it's a good one.
Yeah. There's also Métis grants that exist in different regions, depending on where you are. And what I will say is there are some Métis programs in here. They're obviously only for Métis people. They only qualify. So if you're an immigrant or white or whatever, you're not going to qualify for it. But there are Métis grants, and some of them are very, very well built, like very intellectually put together programs that I wish was available to everybody because they're so well thought out.
Well, we'll talk about two here. One of my Saskatchewan one is amazing. Saskatchewan. So we'll talk about the Métis one real quickly. So I had a client that just went through that, and basically there's a bunch of qualification that they had to meet. They had to be financially stable, everything else like that. But the Métis Nation in this case here actually granted them their entire down payment. Mm-hmm. Now
plus closing costs in some cases.
Closing costs, I think. Yep. There was a stipulation, I believe it was 10 years they had to live in the house. If you sell it before 10 years, there's a whole bunch of repayment, and it's
but good. Because the goal of this thing isn't free money. It's to give you a chance at home ownership.
Yeah.
And if you're trying to game the system,
serious about it.
That's right. If you're going to game the system and be like, I'm going to get my free 5,000 or my 15,000 or 20,000, and I'm going to sell it next year for a profit. Yeah. Well, then you're just taking advantage of the program anyway. In which case, I have no interest in helping you get it. But if your incentive is to actually like break the cycle of rent and get it, it's brilliant. It's a brilliant program.
Yeah, I loved it. And then the other one that I really like, Governor of Saskatchewan, they only had it for like a year. But honestly, if they brought this program out nationally, I'd be jumping.
Are you talking about the grad retention program?
Grad retention. So for those who don't know, in Saskatchewan, yeah, it is brilliant. We have a program called grad retention here. And if you go and get either a post-secondary or a trades degree or certificate, there's a big tax credit for a 4-year degree program. It's $20,000. Yep. It's based on years. So it's not actually what you take. It's based on how many years the program is. There's tax, and I think it's up to $20,000. what the government of Saskatchewan, so you have basically no provincial income tax if you live in Saskatchewan. You have to stay in Saskatchewan was the big thing. So you, depending how much money you make, you could have literally no provincial income tax for a number of years. It's awesome. What they allowed you to do is take 50% of that and apply it as a down payment to a house. Conrad, I don't know if we lost you here, but you froze. We'll see if we get you back here. But it allowed you, oh, there you are, we're back. So the government would allow you to take, of your $20,000, 50% of that towards your down payment. They would literally gift you $10,000 in the case of a couple, $20,000, and you could use that as your down payment. Now here in Saskatchewan,
it's amazing.
That is your down payment on the average house here. It's awesome. Now you had to survive like as long as you didn't sell the house, I think it was within 7 years, it was entirely forgiven. You just got to keep the money.
Well, because it was money you were owed anyway under the grab retention program.
Exactly. So if you sold it, then there was a repayment program. But I really, really liked the way they structured that, because I think, one, it's awesome because, you know, we've gone and we've educated people in Saskatchewan. Let's keep them here so that they live and work here and provide and, you know, add to our economy. And one of the best ways to do this is have them have a house they can call their own. So I loved it. I would love to see the federal government put some sort of program like that together across the country. So you go out and you get an education.
Agreed.
And I don't care. It's a degree from a university. Or
it should have been on a federal level, not on a provincial.
And you go get it and you get this, and you get an education, which is awesome. Always better if you can get an education, and you have a house that you can buy, and you still have a tax credit. Like, this was a win-win-win all the way around. The government wins because they get a great educated employee that's going to add to the government or add to the economy. The person wins because they get a tax credit and they get a down payment. Like, awesome. I wish they had that, you know, across the country.
They used to have a lot more grants. I'm not going to go through them all or any of them. They used to have a lot more. Most of them have gone by the wayside. The programs that we have now, ultra pathetic. They're smoke shows or flash in the pan shows rather, where it's just all no substance and just for political gain. That's it. Ontario, Vancouver doesn't really matter. There's nothing really of value for as far as getting a free 5% to help you break the cycle of rent.
Yeah. Okay, so here's one. We'll talk about this. In the prairies, has increasing interest rates this year deterred investors from buying properties? I think you could say across the country that has deterred them.
Well, it's changed the conversation, because now with rising interest rates that are out there, you need to have a much larger down payment sometimes for the property to cash flow. So that negates a lot of high leveraging investment, which isn't necessarily a bad thing. I don't think you want to be a high leveraged investor to begin with, or highly leveraged rather investor to begin with. But, you know, it's changed what type of properties people are looking at, and that's not necessarily a bad thing, right?
So I'm going to flash like 3 in a row here, because these are kind of all tied together. Same person who's got the question. So can you buy with a 5% without taking the 5% assistance program? I'll let you answer that. I'm going to flip the next question, sir.
Yes, as long as you have 5% down, it's a first-time home that you're buying or a primary residence that you're buying, then 5% down should be possible.
Yeah, and you do not have to take the first-time homebuyer incentive program. You are not obligated, and again, very much situational.
Don't take the FTHBI. First-time homebuyers, it's shit. Avoid it.
There's a few scenarios where it works out.
No, it's shit. Avoid it.
Hey, remember we talked about making hard and fast rules? Stop doing
that. Right. Fair.
Any tax benefits to first-time homebuyers? It's tiny. I believe it was $750, and they increased it to $1,500 tax credit.
It's a participation award.
Yeah, woohoo! You got some of your legal costs back when you
it exists, hundreds of thousands, and it'll happen. It's not great.
Okay. Let's go back. We were talking about it, and we're running really late here, so I don't want to run super late on this, but let's talk about there's also an HST rebate. Yes, there is here. I forgot about that. Sorry. We're thinking Saskatchewan where we don't have HST, we just have GST.
Vancouver, like on BC, has HST rebates that you can do, for instance.
Yeah, sorry, forgot about that.
That's right. That's a big one.
And there's also in some provinces a rebate or reduction on land transfer taxes.
That's right, which is another big one. Yeah.
So there is some more stuff. I shouldn't be so facetious and say there's no benefits. It's just not as much as I guess some people would expect or think. Let's talk about Epic Alliance. I got to go back to that comment here, Conrad. So we'll get back to Epic Alliance here. We talked about the two business models in terms of you could fund a flip with a guaranteed return, or you could have a hassle-free rental property where you had to do absolutely nothing and you got a whole bunch of money, just a bag of money was given to you. Where did they go wrong?
So lots of things. The first is that, I mean, the properties that they were buying, if you ever look at like the neighborhoods that they were buying, I don't think most people really want to live in those neighborhoods. Like some of them, like they're gang ridden. Some of them have like gunshots to the front door and
We're
shit.
talking
Like
about neighborhoods where when you leave the house vacant, somebody will come and steal the copper out of your house. I'm not kidding. I've sold houses in this neighborhood.
that's a real thing.
I don't put up for sale signs like on the front lawn. I actually either bolt them to the fence or I put them in the window because people steal my signs. Those are $250, by the way. Steal my stupid signs. $250.
But like, yeah, they're stealing. Like they would do like $10,000 worth of damage to a kitchen to pursue $150 worth of copper pipe. Like it's that bad. And so they went wrong there where they underestimated renovation costs because of the areas they were in. There was damage while they're doing the renovations, which is shocking as hell. They underestimated grossly the vacancy rates because anytime, for instance, so let's say one was a pickup drop or drop off or pickup zone for a gang, right? And that's what it was being used for. So yeah, they're willing to pay higher rents because who the hell gives a shit, right? I mean, we need a place that we can do our illicit activities. So the moment that it's a drug house and everybody knows it's a drug house, I mean, you have to plan for that thing to be vacant for like 6 months because it needs to be vacant enough so that the whole neighborhood can process through it and be like, oh, that's not the drop-off spot anymore. Because could you imagine? Yeah, it's a drop-off house one day, and then you evict them, and then 3 weeks later, a young family's living in it. All of a sudden, you know, this tattooed
guy shows up looking for his supply.
I'm looking for my cocaine. You know what I mean? It's like, what the hell, right? So the vacancy, so they grossly underestimated vacancies or didn't account for them at all. But even then, they ran into a conflict of purpose. So in a lot of cases, they're like, we want to try to help, you know, all these lower income families. We want to try to help. We want to try to help these landlords make money and stuff like that, which is all fine and dandy. But the problem becomes that when you're taking on all of these financial strains with the mortgage, with the down payment, or with the down payment that you're giving a return on and all that stuff, you know, there's cost to that. And so if you're going to give 15% on that investment, well, you better be generating a rent that's higher than all of that, right? I mean, that's common sense to any investor. The problem is that when you're asking for higher rents in a lower income neighborhood, really, really difficult to do. And then on top of that, so you have to be less picky on the tenants that you want. Typically, when you have a rental, you want to be under the rental market, not, you know, on top of it, because then you have to be less picky as to who you pick. Right. There's some exceptions to that, but we won't cover them tonight. But when you're under that average, you can be picky as to who you get and you can avoid expensive repairs. When you're less picky, you have to stick anybody in there that's going to stop the bleeding. And they typically will do damage to the properties because the reason why they're coming to your place and paying the higher rent is because they damaged the last one and they're struggling to find a landlord that's going to take them.
Nobody's going to rent to them.
That's right. So they're riskier tenants. It's a riskier property. So, I mean, the repairs and maintenance, the R&M, the running costs, like the holding cost of it was just so substantial that it was built to fail. That particular program, in my opinion, was built to fail. Compound that with the fact that, once again, we talked about it earlier, how they were taking these flips, right, and then evaluating them higher so they could sell them over here, and they were running that capital, which I mean is smart in and of itself. But if you were in that program, the one thing that you'd probably want to do, if you could have, is try to keep that house price as low as possible when you sell it to that other investor, because the higher you push that sale price to make more money on the fund to flip program, the more financial strain you are putting on yourself on an ongoing basis with because the mortgage is higher, the down payment is higher, so the return you have to give them is higher, the higher you have to ask for rental, and on and on. Had it not failed when it did, I'm actually surprised it lasted as long as it did. I was expecting it to have failed sooner, which is actually a testament to how good they were at fundraising. But had it not failed when it did, I think in this rate environment, because they were all on short-term loans,
they would have been in a lot of trouble.
I think they were gone regardless. But who knows?
Now, so I put the title on this and circle back to it, and maybe it's a little bit of an embellishment, but I called it an epic real estate scam. Maybe that's being a little harsh, but
we have to wait for the legal to come out. But I would say so far it's clearly indicating that it would be definitely that.
So for those that don't know, we'll touch on it high details here. Basically, the agents when they bought the house, they would get a appraisal on it, and then they would do some renovations, or in some cases, not do renovations at all. And then an appraiser would come in, and it was always, I believe, the same appraiser,
In
and
most
it
cases, yeah.
always appraised higher than what they purchased, whether they did work or not. And so they were able to repay the fund to flip all the time because it always appraised higher. And then I believe they also, for the most part, had only a handful or maybe even one mortgage broker. And correct me if I'm wrong, I believe the real estate agent,
2 mortgage brokers, 2 real estate agents.
And were they not the same? Were they the same people? Was, I think, one of the real estate agents was also a mortgage broker, or not? Or am I wrong on that?
No, two different real estate agents, 2 different mortgage brokers handled the majority of the cases.
Yeah. So we'll say everybody may have been in on it, type of thing. And
I would say in the cases of the mortgage brokers, less so, believe it or not, because I actually know the mortgage brokers who did it. I mean, I didn't touch it with a 10-foot pole because I could just smell something wasn't wrong or something wasn't right from the beginning. You could say that they were happily complacent, maybe because they were
oblivious.
Yeah, because they were processing a lot of files, but I wouldn't say that they would have suspected that values were being inflated or that the rents, like their clients, were being taken advantage. I actually don't think that that's the case.
Okay.
Real estate agents, I actually have no idea. I don't know them.
I think the real estate agents involved in this are going to get hung, and if they did what I think they did, they deserve it.
Right.
I think they were well aware of what was going on.
Someone had to be.
Somebody was. And again, I got to be probably careful what I say. This could be getting me in trouble. But
they haven't been like, so they're still in lawsuits, and I'm sure there will be.
Again, I've got to be careful because obviously it's still illegal. And also I have a code I'm held to not make disparaging comments that are inaccurate towards my fellow agents. So please understand that I have to be careful what I say here. But yeah, so why did they fail? We talked about that. Basically, they underestimated how much they were going to have for vacancy. They underestimated how much it was going to cost to maintain these properties, and guaranteeing profits. Pretty difficult to have a success if you're going to guarantee a set dollar amount or a percentage amount all the time.
Like if someone says guarantee, my red flag goes up instantly. Like it's not to say that you can't attempt, like you could say, yeah, we're gonna try to do this, like we're gonna try to back this. If you say guarantee, how do I get it? And a lot of cases, a lot of these investors weren't doing their due diligence. So what was happening is they say, well, you don't have to worry about the 15% because if ever we stop paying, you have the house.
Yeah.
Right. What a great backup asset.
Great backup plan.
As long as when you made the purchase, the house was actually worth what it was purchased for.
Yep. Or that the house hadn't been devalued because somebody had kicked in the front door and stolen the copper out of it. Or in some cases, I believe there was at least a house that got burnt down.
And it hadn't been replaced ever.
And so, and again, the investor may not have known they potentially bought a house that didn't even exist.
Yeah, it's crazy.
As people, if you're looking at getting into investing in properties, you got to do your due diligence. And if it sounds too good to be true, it probably is.
And I made a couple of videos on this, and one of them was like, what should they have done differently? Never, ever use someone else's appraisal. You can use it as a benchmark and look through it and stuff like that. And if you're a sophisticated investor that has read many, many, many appraisals and you know the area well, and you can do your own back check, great. You can kind of sniff out bullshit. You can kind of sniff on whatever, because it's not like appraisals are perfect science, right? Yep. They're as much art as they are science, right? So even if you get 2 appraisals, we see it all the time. You have a married couple divorcing, both of them hire appraisals because appraisers, and they get different values, right? So it's not a perfect science to begin with.
Yeah, remember, an appraisal is just one person's opinion of value, and that's it. Yeah. And now appraisers, I'm not going to disparage them either, because there's some very, very good appraisers. And just so people know, from my background, my father was a appraiser for decades. And so I actually, as a kid, he used to pay me to staple the appraisals together back when you had to print them out. He used to pay me it was like $5 for everyone I could put in the folder and staple it together. That's where he used to sit down beside him and he would do appraisals. So I've been looking through appraisals since I was a kid. But there's a lot of really good appraisers that take their job very seriously and want to do business right. And I think that's the vast majority of people involved in real estate: mortgage brokers, agents, everybody. They want to do it right. The first question
that they should have had as an investor was, okay, this person has done the appraisal on this one. Is this the same person that's done the appraisal on other ones? Right?
Yeah.
Because And then at the moment the answer was yes, instantly you go, because appraisers want to make money too, right?
Yep.
Could you imagine if all of a sudden appraisals started coming up short? What do you think would happen in that case? Well, that person is probably going to go find another appraiser,
Yep.
right? Because we're having problems with you, right? So the moment one person's doing all of them, that means they're getting values that everybody's happy with, which one by itself doesn't necessarily mean anything, but it does mean that you should probably be getting your own second opinion.
So here's one. Was there any signs of management overpaying themselves as well, akin to an alleged Podgy scheme?
Well, I don't see, and here's the thing. I actually have no idea on that one,
I don't know
because
either.
it's not like they were super wealthy. Like they do come across as individuals that are like, have a lot of work ethic and really do
Yep.
grind and put in a lot. I will say that about them. I do think that they put in a ton of effort into their project. I think their project sucked, but I think they put a ton of effort into it. Whether they paid themselves a gross amount of money, I have no idea. We'll have to see. I know that based on what the lawyer had said, that when they did their fiducial investigation, that previous money had been used, or a new investor money had been used to pay existing investors. Yeah. Therefore, I mean, maybe that's called the Ponzi portion of that scheme. But whether or not any of it was being paid to management, it's difficult to take, especially since a lot of their records weren't properly kept. It's actually difficult to see where all the money went as a whole. So maybe they did, but it's impossible to tell.
Is well on there again. I will be very blunt in terms of, I think they had a great idea. I think the concept was really good.
Execution sucked.
Yeah, but like, there's nothing wrong with trying to do what they did in terms of, hey, we're going to pool investors, we're going to flip properties, and if you're buying houses, fixing them up, renting them, or just fixing them up, like, there should be a profit motive. You should be able to get paid for putting in hard work and fixing up a property that was dilapidated and providing a good property for somebody else to live in. And then somebody else can come in, pay the premium to buy a ready built investment property. Like, I think that the plan was great. Execution was terrible.
I also think they got, because they didn't know their numbers properly.
Yes, smash the like buttons. Love it.
I think because they didn't know their numbers properly, they got into a situation where they needed to grow to outpace previous bad decisions.
Yeah.
And they couldn't handle the growth. So
this one's a good question. Talking about purchases and appraisal. So I'll talk about it from a real estate agent perspective, buyers, and Conrad, I want you to talk about it from a mortgage broker perspective. One of the pieces of paperwork that we fill out here in Saskatchewan is called ancillary services. And it's basically a legal document that talks about all the things that you should do when you're buying a property that the Saskatchewan Real Estate Commission recommends that you should do, that I as an agent don't provide. And one of them is an appraisal. And I tell them that part of buying a house, we can go and we can get an appraisal done. And the appraiser can come in and give us their opinion of buy. Now, I feel if I've done my job right, you as a buyer are going to know what that house is worth within a reasonable range. Is that range 25,000, 50,000? Depends how unique maybe the property is. But I want to educate you so that you will go, okay, you know what? I think this price is reflective of what the value is. But at the end of the day, too, the appraiser can come in and say the house is worth $1. And the seller can say, great, I want $200,000. You can't force them to sell for that amount of money. You can choose not to buy the house, though.
Right. And sometimes financing requires appraisals.
Yep.
And in a lot of cases, or in some cases, it doesn't. And it's more prevalent depending on which market and which market environment that you're in. For instance, if you're in Toronto right now, an appraisal is almost all guaranteed to be needed, right? Yep. With just how much housing prices are changing, right? In a rapidly rising rate environment, appraisals aren't necessarily, or in a rapidly raising housing environment, housing or appraisals aren't necessarily as important, because a lot of people make the assumption, and so do lenders, that the house that you're purchasing now is going to be worth tomorrow, which maybe is true, maybe isn't, but the direction is in the right direction. In a declining market, that's different. The only time that appraisals are requested is when housing prices are being bought above what it's being listed for, in which case it's used as a fact check to make sure, is this property actually worth what the person is paying? And if there's a disparity, you have to pay that in cash if you still choose to buy it.
Couple of things too in terms of appraisals. One, if you are concerned that the price you're willing to pay isn't fair, isn't right, one, maybe the agent you've got isn't doing their job right, because they should be able to provide you the information. And if you don't trust them that they're giving you good advice, don't hire that agent. But go out and get an appraisal and get their opinion of value on it and see if that makes sense. But also remember with appraisals, they are beholden to essentially previous data, because the way appraisals are done essentially is there's three main ways, but two are the most prevalent. And the first one is the direct comparison, where you're going, okay, what do houses in the neighborhood sell for? If you're in a rapidly appreciating market or depreciating market, either way, the appraisal values trail what the market is doing. And I was talking to a friend of mine out of Montreal about 8 months ago, and he was saying you can throw the comps out the window because houses are appreciating at 3, 4, 5% a month. So it doesn't matter what comparables you use, they're all going to be not applicable anymore. And then, of course, the next way that you do an appraisal is the cost of replacement. So they go, okay, what would it cost to rebuild this house? And then you have to devalue it for how much it's been beat up and lived in and used in. Most common is the direct comparison approach, but the replacement cost is another way to do an appraisal. But again, they're beholden to essentially past data if it's past sales, but also replacement cost. You know what the materials cost 6 months ago, 8 months ago. You don't know what they're going to cost you in 6 months to build something. So that is also one problem with appraisals, is they may not be accurate depending on market conditions. Okay, here we go.
I've got about 10 minutes left.
Yeah, we'll finish this up here, guys, in 10 minutes, and we'll try to get through these questions. So this one, I haven't been following this. Conrad, have you been following this one?
I've heard rumblings. I don't know enough about it to accurately be able to comment on it. What I will say is, like, who cares in a lot of ways? Big corporations buying. I mean, it doesn't change really anything. Like, yeah, they might buy it for far, far less, or far, far more rather than what it's worth, in which case, great to whoever currently already holds it, right? It doesn't change anything as far as supply. It doesn't change anything as far as what the rental market's going to hold, because they're not going to buy 4,000 single family homes on the same street.
Yeah.
So.
Okay. So here's one. I'll try to go this one here. I'm gonna go through them kind of quickly here. Do we expect to see rental prices go up, especially in Toronto, Vancouver, as we see in the US?
Yes.
No. Yeah.
100%.
Yeah, they already
Supply
are.
and demand.
We're already seeing bidding wars on rentals now. How about that? People are throwing money saying, I will pay you this much more than what you're asking. And partially that's due to those buyers who are sitting out right now going, I ain't going to buy in this environment because I'm scared.
100%.
These are qualified, well-financed individuals that can compete in against rental people and people looking to rent potentially unfairly because they have more money available to them, whereas normally they would buy. And so, yeah, we're seeing competition for rentals. I think you're going to see rents increase.
You have all these buyers that are no longer buying. Anytime you remove a buyer from the equation, almost always you add one renter to the equation on the other side. More renters. The only time that that's not true is in your family formations. You might have, for instance, some children who choose, or not children, but young adults who choose to stay at home rather than going out and rent, rather than going out and buy in this environment, which reduces the demand kind of as a whole, but only fractionally so. So rents are going up.
Okay, this one kind of plays into that. Do you find REITs to be a positive, negative influence on the market? They're just a influence.
Yeah, they're influence, and I would never invest in one like ever.
Remember too, a lot of REITs are more focused on commercial properties than residential. There are residential REITs, but for the most part, they're either focused on commercial, like strip malls and things like that, or large multifamily apartment blocks. They're typically not investing in a single family home.
Yeah, I have zero interest in investing in a REIT.
This was one I missed here, but I think I got it here. Talking about what's going to be considered when you have as rental income from, say, a basement suite. So I believe I've got the question correct here in terms of, I'm buying a house, it's got a basement suite. How does that impact my qualification?
Yeah. Different lenders have different rules. Some use DCRs, some use add to gross, some use add backs. There's different calculations for different, so it affects it differently from the lenders. But none of them use 100% rental income when you're buying high ratio, which is less than 20% down, which you can't do anyway. But if you're buying something with a legal suite, for instance, I'm buying the top, renting the bottom. Some people try to do that. It's not dollar for dollar. So when you're buying something, either a rental house or something that you're planning on living in, that's a rental owner or an owner occupied rental where you're owning one side of a duplex, for instance, or a suite, they will use some of the rental income to support it. But my recommendation is always never rely on the rental income to purchase well above your means. Often that can lead you in trouble, because then you're in a situation where you're required to basically have a renter in there. Otherwise, you can't afford the mortgage payment, which, I mean, you probably still can, but it's less ideal.
Okay, another one here because we'll fly through these before Conrad has to go. If there are defects found in a house, say structural, would that help negotiate? Yes and no. I've had this where we found defects in houses and we've been able to get price reductions for that. I've had situations where the sellers just say no. So yes, it can, very much situational. If you do find defects in the house, try to go back and look at it as is this something that I can just fix myself? Is it something I don't want to buy this house anymore because of, or is this something we need to negotiate on?
And
So
sometimes the defect is already priced into the house,
yes,
which
yeah,
is one portion of it. And other times it just allows you to determine if you want the house or not.
yeah. So very much case by case. This one here, I saw a seller's realtor pushing his appraisal. Is that safe or should you get your own? If you're feeling comfortable with the appraisal, go get another one. Get one with somebody you feel comfortable with.
Well, I think the answer is in the phrasing here. He's pushing his appraisal. If someone's pushing anything, you should definitely fact check it.
Yeah. And don't as well misconstrue potentially. Like, again, there's really, really good appraisers, and the agent may be saying this is, a really good appraiser. Again, if they're pushing, yes. If they're just saying, hey, this is a great appraiser, he may be entirely correct too. This is a great appraiser that knows
Just
what he's
because
talking
someone
about.
else did it doesn't mean you know what?
Yeah.
You can also call the appraiser too that did it. Have a
Yep.
conversation with them. What'd
Ask
you think
him
of the
how he came
property?
about his
What'd you do?
value.
Yep.
Yep. Don't be afraid to do that. Okay. So, with that, guys, we'll get ready to wrap this up here. First of all, I want to say thank you very much, Conrad, for coming out and spending 2.5
Yeah,
hours.
this was fun.
I
I
plan to
enjoyed
do an
this.
hour, by the way, guys. And so your questions were awesome. I appreciate it. Yes, smash the like button, subscribe if you guys haven't. Check out Conrad's channel. He's really focused on the mortgage side of things, whereas I'm more focused on the real estate education side of things. He's great videos. He dives deep into Epic Alliance even more than we have here. And I'm probably going to do an Epic Alliance video and steal a bunch of his information. Don't tell him I'm stealing it. But reach out. I will put in the description below once I fix this up with Conrad's contact information, so you guys can reach out to him with any questions you guys have. Thanks very much, Conrad, for coming on. Thanks everybody for coming out tonight.
The
And
questions were great. It was awesome.
Questions were great. If you guys want us to do this again, let us know in the comments, both in the chat, but also in the actual comments you can put later. Say, do this again, and we'll find a time to do it because I find this fun.
Yeah, me too. I enjoyed this.
But thanks very much, guys. Really appreciate everybody. Have a good night.